Money gets more expensive and the Fed doesn't seem to mind. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. You take a look at a U.S. equity market that can't really decide what it wants to do. You have the S&P 500 in the red right now. It was in the green, not so much right now, currently off by about 0.2%. It's the same story if you take a look at big tech, the NASDAQ 100 down about 0.2%. All the while, you take a look at the bond market, 10-year yield currently up about 5 basis points. It was even higher earlier, within a whisker of that 5% level. We didn't quite get there. We'll see if that's a possibility in the next couple of days. Meanwhile, you take a look at where money is going. It's not going to the dollar. The Bloomberg dollar index down about 0.3% at this moment, Romaine.
Yeah, a big focus today is going to be on the Fed, its rate hikes, and the impact on the market and the economy. Fresh data that we got this morning showing that the ghost of a housing market here in the U.S. Contract closings on existing homes down 2% in September, actually down 19% year over year without adjustment. The number of homes transacted, the lowest since 2010. A 5% plus Fed funds rate feeding into an almost 8% average mortgage rate. It'll do that. Morgan Stanley's James Egan put an even finer point on it on the Odd Lots podcast, saying the effective rate of existing mortgage balances is around 3.6%. That represents the widest gap relative to the prevailing rate for a new mortgage in at least 40 years. That's not a lagged effect, by the way. And the Fed's 19-month-long tightening campaign to curb inflation, it's upending other parts of the economy as well, including deal-making. With banks showing little willingness to back large mergers and acquisitions, there have been only $1.9 trillion in global deal transactions for the year through the end of September. That sounds like a lot, but that's down by $1 trillion from 2022 already, putting deal makers on pace for their worst year in a decade. Private equity firms also getting hammered as well. Value of their acquisitions down 45%. And the problem now is that no one really seems to believe Treasury rates are actually done rising, Katie. I mean, maybe there's some crank out there who believes that, but when you take a look at the 10-year and you see how we came so close to that 5% level today, a gritty neighborhood that we haven't been in since 2007.
Yeah, you take a look really across the curve, it's the same story. Rates are high right now. Right now we have behind us the 2-year, the 5-year, and the 10-year. And you can see, again, it's the same story across those tenor. Yields have been climbing, particularly when you focus on the 10-year here in yellow. Again, we got very, very close to 5%, as Romaine said, within a whisker. And just looking at the direction of travel, it seems like an inevitability. You take a look at really where that puts us in history. We're at cycle highs right now, close to around the levels of the mid-aughts, and from there around the turn of the century. And of course, this really translates into a lot of Treasury volatility. You look at the lines on the screen, you compare that to what we're seeing in the stock market. We're talking about the world's biggest bond market, more volatile than the stock market right here. You have TLT in blue. This is the realized volatility. As we've been talking about, of course, it has surpassed the realized volatility of SPY, which tracks the S&P 500. We're talking about what's supposed to be the ballast of your portfolio, Romaine, but clearly it's one of the more volatile assets out there right now. And
Fed Chair Jay Powell was actually asked about some of that volatility. He was sat down over at the Economic Club of New York with our very own David Weston. And he actually talked about this idea that the U.S. Central Bank is inclined to remain steady with regards to rates at the next meeting, but still leaving the door open for the possibility of another hike. Let's take a listen as to what he had to say.
We certainly have a very resilient economy on our hands. We've got the economy growing strongly. If you think back a year, many forecasts called for the U.S. economy to be in recession this year. Not only has that not happened, growth is now running for this year above its longer run trend. So that's been a surprise, driven largely by consumer spending, driven by a very strong job market with people getting jobs with first high nominal wages, and then as inflation has come down, real wages, which is spurring spending. And we've also had inflation coming down. So, you know, it really is a story of much stronger demand. There may be some ways in which the economy is less affected by interest rates. It's hard to know precisely, but for example, many companies, any company with bond market access will have termed out its debt, right? And therefore may not be feeling the effects of higher rates. The same may be true of homeowners who have a long-term fixed rate, low rate mortgage. who then are therefore not, because it's not an adjustable rate or a higher rate, they're not feeling that increase in rates. So the economy may be somewhat less susceptible to the effects of rate increases. On the other hand, if you look at interest-sensitive spending, these are very much the places where we expect to see and do see effects. So, for example, in housing or the housing sector has been very affected by higher rates, as purchases of durable goods. If you look at surveys, people will not say that it's a good time to buy a car or a house, quite the contrary. So we see policy working through its usual channels. It may just be that rates haven't been high enough for long enough, and again, it's all happening in a context of very strong demand.
We've heard other people speculate maybe the terming out of debt, as you say, both corporate debt and household debt, may diminish the effectiveness of rate hikes. Do you have a view on whether that's true? And if it is true, what does it say about monetary policy? Does it mean you have to go farther in the rate hikes, or do you just not have the power to affect it?
So no, I don't think that there's a fundamental shift in the way that interest rates affect the economy. There may be some differences in this cycle because of what I mentioned. As I mentioned, we are seeing the effects where we expect to see them, which is interest-sensitive spending and also asset prices to some extent, and the exchange rate, which you're also seeing a strong exchange rate, which is disinflationary. So I don't think there's a fundamental change in the way monetary policy affects the economy. And again, it goes back to just very strong demand. We take the economy as it is. We take fiscal policy and the economy and all the things we don't control, they come to us, and we conduct policy always to achieve maximum employment and stable prices. So we just take what comes. The fact that we have a strong growing economy, a strong growing labor market, and inflation coming down, these are the elements that we want to see that to achieve the outcome we want. It may take more time, but ultimately, this is the kind of thing you would want to see along the path to getting through this without a big increase in unemployment.
The chairman of the Federal Reserve, Jerome Powell, speaking earlier with David Weston at the Economic Club of New York. Pleased to say David joins us right now on set, the host of Wall Street Week. David, this was a great interview, by the way. And one thing that really caught my attention was that discussion in that interview about the lagged effects of monetary policy. And he kind of alluded to this idea that the Fed has to use their eyes, I think was his quote, and sort of show some patience, show a degree of risk management. That didn't necessarily sound like data dependence to me.
Well, it was fascinating to me because what I asked him was, how far along are you in that lag? I mean, are you 25% of the way, 50% of the way? And he said, well, we really don't know. And I said, well, how do you form monetary policy if you don't know how far you are? And it was sort of like, I'll know it when I see it. Yeah.
I thought that was interesting, too, because it kind of gets to this idea that we've heard from other Fed members, this idea here that kind of the easy part of this rate hiking cycle is beyond them, that now it is kind of wait and see and hope that when they do make their next move, whether it's up, down, or whatever, that they feel it's appropriate.
Well, and we may be seeing that in the markets. Yeah. A lot of uncertainty and a lot of volatility, particularly in the bond market, as you know, has been so terribly volatile because it's really hard. I think a lot of people wanted Jay Powell today to say, okay, we're going that direction or we're going that direction. Yeah. I at least didn't really hear that. There was some suggestions about maybe some trimming, maybe here or there, but no definitive direction, at least that I got out of what he had to say.
But that's led to a lot of volatility in the market, and you posed that question to him about how comfortable he was with that volatility.
Yeah, and he said they're watching it very carefully. They're certainly very aware of it. They hypothesize about a lot of the reasons for it. But at the same time, he didn't seem to suggest that they need to do anything right now. That doesn't pose a systemic risk, at least yet. Although, as you know, Romaine, when you talk to a lot of people who are actually running businesses and making investments, they're kind of nervous.
He also addressed this idea of this big jump that we've seen in rates, particularly at the longer end of the curve, and how, in his words, to a certain extent, that might actually be doing part of the job for the Fed.
Well, he did admit to that, and more or less, because I asked him that, and he said, yes, on the margin, that does tighten financial conditions, and that necessarily means you don't have to raise as much. He allows out, on the margin, that would be true. I mean, who knows what that means? Not so much for November, but December is, I guess, what we're really looking at now.
And I have to ask you, this took place at the Economic Club of New York here in Manhattan. You were supposed to start at a specific time. That was disrupted a bit by some protesters. What was happening at the start of this this?
Well, a group of people came in, I think it was about 6 or so, men and women, and they had a banner, and they were chanting about climate change. And the fact that Jay Powell should do what he could to really make sure we're not investing in fossil fuels. And they were quite tenacious. They would not leave. And they sat down, they went up on the stage where we were about to talk, sat down in the chairs, and it took a while actually to escort them out, which ultimately happened.
So a disruption, but he was never in any danger, was he?
No. I was seated next to him, and early on, his people came to him, and I certainly encouraged. I said, "You should just get off the stage. I mean, this is not helpful." And so he just went off the stage to a holding room for a short time, and then came back on.
All right, David Weston, the host of Wall Street Week, who joins us every day for his Wall Street Week daily segment, fresh off that interview with Jerome Powell at the Economic Club of New York, and you can catch more highlights from that interview on Wall Street Week, which airs 6 p.m. on Fridays, New York time, right here on Bloomberg Television. Katie?
Well, it was such a great conversation with Fed Chair Jay Powell. Our thanks, of course, to our own David Weston. Let's keep the conversation going now with Lawrence Meyer, former Fed governor and chairman and co-founder of Monetary Policy Analytics. And I actually want to start with the bond market and what we're seeing at the long end. Of course, that conversation with Chairman Powell took place in the context of the 10-year yield just about getting to 5%. Of course, it sounded like Jerome Powell didn't see any need for alarm right now. But from your perspective, of course, as someone who helped make monetary policy, at what point does that rise in long end yields go from something that's simply tightening financial conditions to a potential source of instability?
Well, it's interesting because I don't understand why the markets initially responded like that. They took it back. There was nothing in the speech that should have moved markets, and he didn't want to move markets. Now, it's true that the most important development since the last meeting is the rise in long-term rates, more restrictive financial conditions, and that, if sustained, could substitute for at least one more hike. I think that's what he was indicating. With respect to November, there's no chance. The probability is zero now that there's going to be a move at the next meeting, and there's very little chance there'll be a move in December. And what he said was consistent with that. If I could make one point about his comments today, and this is really clear in his prepared remarks, they're improved in one respect. And I say improved because more consistent with my view. He's now saying instead of below trend growth likely being required to get to 2%, he's saying that, well, most of that is really due to easing of supply conditions. And that's why we've seen an easing without an increase in the unemployment rate. He also misread history to say history says that it's not possible. We have no historical precedent for today. We've never had a supply shock increasing inflation so much while inflation expectations were well anchored. This is unique.
He also said when asked about where long-run neutral is that simply he doesn't know. And when you think about all those different factors, all the different forces in the economy right now, do you think neutral has moved higher?
I do. And if you recall, in the last macro projections from the participants, they raised their expectations for the funds rate from up a half a percentage point, from 2.5 to 3. We do think that the neutral rate has risen a half a percentage point.
Larry, I want to read something to you. Maybe a couple decades ago, you actually addressed the Economic Club downtown here in New York. Yeah, you're chuckling already. I think you know where I'm going here. And I'm going to read this for you. It says that the challenge for monetary policy is to facilitate a transition from the current exceptional but unsustainable state to the best possible sustainable state. This is not an easy task. And 19 months into this rate hiking cycle, do you think that the Fed is making meaningful progress in achieving that?
You know, I absolutely do. I mean, as I say, so far, there is considerable progress on inflation. He could have noted that real progress on inflation that we've seen, and without harm to the labor market and the unemployment rate. So things are going very, very well.
And you're comfortable with this idea, too, when he talks about this idea that sort of being data dependent has now shifted to a certain extent to sort of waiting and seeing, using their eyes, using, I guess, what they can feel rather than just necessarily what's in the numbers.
That's exactly the point. Wait and see, patient. The data is going to have to push them to go again. Not November, not likely December. maybe after that, but we're close. And I said, the question is, are we there? Pretty close.
All right, Larry, always great to catch up with you. Dr. Lawrence Meyer there. He's a former Fed governor and co-founder of Monetary Policy Analytics, helping us kick us off to the close today. A conversation coming up after the break with Torsten Slok, chief economist over at Apollo. His take on the 10 biggest downside risks for the U.S. economy right now.
Plus, Disney's ESPN could be worth $22 billion to outside investors. We'll have the latest on the potential for a deal and who might actually be interested.
And it's a big week for airlines. American Airlines beating for the quarter, but cutting its forecasts going forward. Higher fuel costs, a big part of the story. We're going to dive deeper into the challenges facing the airline sector. That conversation and so much more coming up here on The Close. This is Bloomberg.
This is the countdown to the close. I'm Katie Greifeld, and Invesco's Ananya Lodaya is saying that growth stocks are the place to be for the long term, writing, quote, "We are in a period of middling growth as the economy trundles on, and in that scenario, growth equity outperforms value hands down." And Ananya, I'm thrilled to say, Invesco International Growth Equities Portfolio Manager joins us now for more. Hands down, when we're talking about growth, I mean, my brain immediately goes to tech. Is that what you're talking about here?
First of all, thanks for having me on. Great to be here. I'm talking about durable growth. Anything, it doesn't have to be, knock the lights out growth, but anything that's respectably above GDP and durable, that being the underlying keyword. So basically companies that have high market shares, good industries, pricing power to protect margins, balance sheets that don't depend on the capital markets, and copious amounts of free cash flow gathering in the bank. And usually the kind of company that has that durably has some fillip of growth to survive, that if it's doing well through periods where the backdrop is middling, as it kind of is right now, right? Admittedly, Chairman Powell himself said he expects growth to be below trend in the foreseeable future. And counterintuitively, the data actually shows that growth outperforms equity, and there have been a number of hypotheses as to why that is. But we're very excited about durable growth trends that look like they're going to persist for the next decade or so. Things like, we call it mantra, mass affluence, new technology, restructuring, aging, all these big themes that are really driving human economic activity right now.
And when it comes to growth versus value, hands down, I love that phrase. Is that related mostly to the macroeconomic backdrop? Because I think about sort of the competition right now that the bond market is providing, cash is providing 5 to 6%. You think about sort of the earnings growth that you need to see to justify not just sitting in cash. Would imagine that means growth companies.
The biggest driver of economic or stock returns longer term is the power of compounding, right? So you want to find something that can compound continuously and withstand volatile periods, so you don't have to bear the burden of that great drawdown and then sort of start to dig your way up out of that hole again. And growth companies in this environment tend to have the most self-help in terms of operating leverage from volumes if they're growing. But the other part of the equation that I think people tend to overlook is that in difficult economic times, capital access is something that has to be won. 5 years ago, everyone could raise money, right? And now with all the ankle biters, the companies that sort of never deserved a seat at the table but got in with free money, with those guys getting sucked out of the system, it's a better time than ever to be a good company with durable prospects.
But what does that mean, though, for the broader market? Because when you talk about exactly what you just said, and I feel like a lot of investors were looking for that, but as I'm sure you noticed, in the first 6 or 7 months of this year.
Oh, I think we're having some issues with Romaine's mic. But while we sort that out, talk to us a little bit more about access to capital, because something I've been thinking about with a lot of these small cap companies, they have to tap the debt markets over and over again. And you think about this higher interest rate environment that we're currently in, that's obviously a painful thing to do when you then have to refinance that debt. How do you think about that when you're identifying growth companies?
The first thing we look for is companies that are self-funding. So companies that aren't based on a jam tomorrow thesis of, we will build it, someday they will come, and meanwhile keep funding us. So I think the very long duration growth, which is sort of based on hopes and dreams, is sort of out of favor, and rightly so. But there are plenty of very good companies that are compounding, sort of double-digit earnings that have lots of free cash flow, so they can keep sustaining their own funding needs. And those companies are poised to thrive in this environment, right? Especially because the competition, the biggest factor impacting a company's ROIC, or one of the biggest, is the degree of competitive intensity. And in times like these, the degree of competitive intensity draws down considerably.
All right, hopes and dreams, ankle biters, a lot of great phrases. Ananya, really enjoyed this. Our thanks to Ananya Lodaya, International Growth Equities Portfolio Manager over at Invesco. Much more markets coverage coming up. This is The Close on Bloomberg.
Blackstone was out with results earlier today, reporting a 12% profit decline. Higher interest rates and a pullback in deal making hitting the bottom line. Stanley Bostick had a chance to sit down with the president and CEO, John Gray, to get his thoughts here on what happened in the quarter.
When we look at the quarter, Shanali, we're actually pretty proud because despite the slowdown in transactions and realizations, our distributable earnings were remarkably steady based on the fee-related portion of those earnings and the management fees that underlie that. Also, I think the most important thing is really delivering for our customers. We did that across the board in the quarter, particularly in infrastructure, life sciences, private credit. But to your question, when the deals come back, I think we need some stability in rates. I think the Fed is pretty much done here. They've taken short rates up quite a bit. I think long rates have now moved quite a bit. And so that's going to lead to some tightening here, further tightening. But what investors want, of course, is a bit of stability. And I think ultimately we will find at some point some stability in marketplaces, particularly in treasuries. When that happens, I think you will start to see transactions pick up again. They are at a muted level, but it doesn't stay like that forever. These things are cyclical. And the key with our business model is we're not a forced seller of assets, and we have more than $200 billion of dry powder. So we can invest into the dislocated market, and often we do our best work at the times of greatest uncertainty.
Yeah, John Gray speaking a little bit earlier there, Katie. And I mean, you can't really understate this point here. $16.2 billion in new inflows that they had here. That's about a 50% drop from what they had the year before. And this is a company that obviously lives and dies by those fees.
Absolutely, and you're seeing that in the shares today, obviously taking a beating. And from that interview and the coverage today, what caught my eye, that you take a look at their dry powder. They're sitting on $200 billion. So an interesting moment here for Blackstone. Yeah, and this could be sort of a big catalyst should we actually reach more favorable market conditions. But for at least right now, feeling the stress, those shares down 7% here on the day. A lot more coverage coming up here on the close. Stick with us. This is Bloomberg. This is the countdown to the close. A mixed day in markets right now, from equities into the Treasury space. Let's check in right now on what's going on with commodities. And Abigail Doolittle standing by right now with our commodities close. Abigail.
So we have some mixed action for commodities also, at least beneath the surface. The Bloomberg Commodity Index up slightly on the day. New York crude oil up for a second day in a row, up 1.2%, despite the fact that there is a deal with Venezuela that will help increase supplies. Investors still focused on geopolitical tensions. Wheat up for a second day as well, up 2.4%, the best 2 days going back for about a week or so. To the downside, though, natural gas down 3.3%. This as U.S. natural gas storage came in bigger than expected. And then finally, sugar, these obesity weight loss drugs touching all parts of the markets, down 0.7%. And it does seem to have something to do with the idea that Americans, consumers, might be eating less sugar going forward. And that could be a little bit of a drag today on sugar due to those obesity and weight loss drugs.
All right, Abigail Doolittle there with a nice wrap up of what's going on in the commodity space. Let's turn now back to equities and back to Disney. The company yesterday providing a peek at its ESPN and sports related businesses for the first time as a standalone business here. We got an interesting peek into how much revenue it generates and, more importantly, how much profit. Profit at the sports TV networks, it was down 20% through the first 9 months of fiscal 2023. But But there were a lot of signs there that this is still a pretty healthy business and one that is causing a lot of speculation as to whether it could be bought. Michael Wolff is joining us right now. He's the CEO over at Activate. And Michael, you know there's been so much speculation and maybe just wishful thinking by investors that Disney does something with ESPN.
Yes.
This was the first time where we really, at least those folks of us who are outsiders, got a chance to really see actual numbers as to what this business could potentially be worth. Were you surprised at all by those numbers?
I wasn't surprised. I mean, coming back to commodity prices, it's unlike sugar. Americans are consuming more sports. And when you look at it, $12.5 billion in revenue, $1.9 billion in profits. And I'm not sure, but they've added in the losses from Star, which is part of their sports group, Star India. So this is a great business, and 47 of the top 50 shows on television are sports. Americans are hungry for more.
I am curious about this general idea when we talk about particularly linear television and the idea of sort of what works on linear television. I mean, the general consensus has been that live sports certainly works, and I understand ESPN is more than just live sports. But the idea that they would jettison something that is kind of, at least for right now, the big ballast, the sort of the last vestige of the glory days of linear television, is that a signal that maybe that too is waning?
I mean, I think, of course, investors are looking at Disney and saying, okay, we know the cable universe is declining. We know some sports are going to streaming. And so what's the future of it? A couple of things that are very bright spots. One of them is that Jimmy Pitaro, who runs ESPN, is a great manager. The second is they just did a big sports gambling deal with Penn. And so there's a lot of reasons why people should be interested. And also, I'm very optimistic about their ability to have a successful ESPN streaming service. And so you've got two strong sports businesses in the U.S. You've got ESPN and you've got Fox Sports. And both of them, people are going to want to watch sports, even if they don't have pay TV at home.
Well, Michael, that's where I wanted to go, because we know that, Disney is looking for an investor to help accelerate ESPN's transition into streaming. And of course, you think about the live sports point. Is that the right direction? Is the writing on the wall here that streaming is the future?
Well, nothing from a reliability of revenues and earnings, nothing beats being on cable. And part of it is just every home that has cable has ESPN. But over time, there's no reason why this isn't going to be a business. Disney's packaging it with Disney Plus. And yes, the other streaming services are going to take on sports. But to be clear, the leagues have an interest in ESPN being strong. They need to have multiple people to sell and companies to sell their services to. So I'm actually optimistic longer term about this. And if they're going to do a deal with somebody else to take on some of the customer acquisition cost and the fees for rights, then it's going to be a smart move. I'm just not sure that it's necessary for the long term.
And if there is a deal to be done here, who do you think would be the type of investor who might step in and raise their hand for ESPN?
It's a parlor game. I think that the private equity companies might be interested, and there may be other investors. Let's not forget that ESPN, 20% of ESPN is owned by Hearst, which is an incredibly well-managed company by Steve Schwartz, and the two of them, they're going to figure out ways of getting this done. I just don't have, it's anybody's guess at this point.
I do want to ask you just a broader question, Michael, just kind of about advertising, well, not just on the linear networks, but even on the streaming service as well. There was a lot of discussion last night about Netflix and its new ad tier. And we know Disney, of course, has been pushing into that streaming space here. Is the advertising space in the streaming world, is that going to be basically a replication, I think, of what we traditionally saw in the linear TV space in the years of old? Or is that going to be something that's completely different and insulated in a way that maybe in the past that we saw on linear TV it wasn't?
I think it's going to be somewhere in between. If you think about it, advertising on any of these streaming services, it is a substitute, and in some ways, it has the advantage of having fewer ads. On the other side, advertisers want, especially when you're talking about some areas, they want simultaneous reach. They don't want to just cume it up across a set of programs. They want to know somebody watched this program in this moment, what they were viewing. All of the streaming services are adding in an advertising supported tier, and that's about just keeping subscribers there. But I think that that advertising is still going to stay with the linear networks and large distributed networks like ESPN.
All right, Michael, great to speak with you. Our thanks to Michael Wolf, Activate founder and CEO. Still ahead, we'll get a bird's eye view of the airline industry from the Director of Travel Research over at Melius. Stay tuned, rather. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off here with Netflix, riding high on the wings of that strong subscriber growth. And analysts are following that sentiment. Morgan Stanley bumping up its recommendation to overweight, saying that the password crackdown, it's working. And the competition, it's pulled back. And that increases the probability that Netflix can meet some of those targets for accelerated revenue growth and expanded margins. Netflix having a phenomenal day, 16% higher. Next up, Peloton, feeling the burn, and this time it's from Bank of America. Bank of America dropping its recommendation to underperform. What the analyst says, he actually went out and reviewed 3 years of data for Peloton's top cycling instructors, including Ali Love, and he found a steep drop in the number of classes taken per subscriber. That decline in engagement could be exacerbated by what he expects to be an increase in subscription cancellations in 2024. Peloton shares, which were down earlier in the session, now higher by about 1%. And finally, let's take a look at United Airlines. Raymond James trimming its price target just a bit, 68 to 70 from 70. This following the company's cautious Q4 guidance, though the analyst actually found a bright spot. He says that airline's outsized exposure to corporate and international travel could prove to be a net positive in the medium term. The share is relatively unchanged on the day, and those are some of our top calls. We do want to stick in the sell side space, and we want to stick with airlines. American Airlines came in with its earnings earlier this morning, topping expectations for third quarter profit, even though it did warn of a tough road ahead, revising its guidance down from its previous guidance. But investors, at least for right now, seem to be taking it in stride, with the shares higher on the day. Conor Cunningham, he's director of airlines and travel over at Melius Research. He's joining us right now to talk a little bit more here about what's going on with the airlines. And Conor, it's interesting to kind of hear what we've to see what we've gotten already out of United and, of course, out of American Airlines today. Let's start with American, because they were pretty clear about this idea of just how much fuel costs are really starting to impact the bottom line.
Yeah. So yeah, fuel's been on the rise. You know, the prospects of a further escalation in the Middle East obviously are not going to be good for that. From my standpoint, fuel kind of is what it is, and airlines really can't control that. What they can control is the supply within the industry. And right now, you got a couple bad actors out there that are kind of putting a fair bit of capacity in the U.S. domestic market. So the airlines that used to have pricing power, I'm sure that you and people around used to complain about those fares all the time. They've started to cool a fair bit, specifically within the domestic market. So airlines that don't really have premium services or international exposure have really struggled. The Delta, American, and United all do kind of play within those same buckets. Mm-hmm. I think the issue really for American is their relative margin performance has really been underwhelming relative to Delta and United. So, think about just this third quarter, they did about, I think, 5.5% in terms of operating margins. Right. Delta and United were these mid double digits. So, again, they've just been lagging in that overall recovery phase so far.
I am curious, though. I mean, how much help are they going to get from just an increase in travel, or at least some sustaining of the trends that we've seen here? Some of the reports that we got coming out of this earnings release was this idea here that bookings heading into the holiday season, at least here on the U.S. side, domestically, are running below where we would normally have been in previous years.
Yeah, I mean, what I would say about that is just the peaks in general. If you talk about Thanksgiving and Christmas, I'm not all that worried about those type of timeframes. People will travel for those periods in general. The issues right now that I see are more on these off-peak timeframes. So we're still continuing to wait on business and corporate travel starting to recover. It's gotten a little bit better. You've heard some green shoots there, but it's still, slower than overall growth that we would like to see. So these off-peak timeframes are going to be pretty difficult, and that's also when there's just a lot of capacity that's been added to the system, specifically within the domestic market. So keys for me going forward are going to be more around people being rational with their overall capacity outlooks. Alaska today made an adjustment into first quarter of next year, pulling down some capacity. So that's a nice rational move. But we're really waiting on the southwest of the world potentially making an adjustment next year as they're growing a fair bit right now. So until we see that, the group is kind of in for tough sledding right now because pricing power is slipping as we kind of see it.
And Conor, let's talk quickly about American's new pilot contract. Of course, we know that there's been a pilot shortage that's affected American as well. Now that perhaps the contract is in place, it's signed, when will that translate potentially into more pilots actually flying planes?
It's a good question. So, the pilot issue has been an ongoing thing for quite some time. What I would just say is that it doesn't appear to be a pilot shortage anymore, specifically at American. If you think about it, like American, Delta, United, Southwest are all destination airlines. So if you're a pilot, that's where you can make your most money. You can basically move up into these wide body aircraft where you make a fair bit. So from a demand standpoint for pilots, they're not actually struggling to find them. I think part of the problem right now is that there's still a lot of constraints that are within the market. Delivery delays from Boeing and Airbus. We've talked a fair bit about air traffic controllers, specifically within the New York market, where they just don't have enough, so they're limiting the supply there in the near term. So it's not that there's a pilot shortage. I think that a lot of those issues have been rectified. It's now these constraints that are out there that are still kind of hurting the airlines from a growth standpoint.
Conor, great to catch up with you. Conor Cunningham over at Melius Research. A closer look at the airlines, a couple of big ones already reporting. A lot more coverage coming up here on the big program, including a look at geopolitics with President Joe Biden set to deliver an Oval Office address later in the evening on Israel and Ukraine as the White House eyes a $100 billion request for military aid. More details on that. This is The Close on Bloomberg.
Well, President Biden is planning a primetime address from the Oval Office later this evening, discussing the attacks against Israel and the ongoing war against Ukraine. For more on what to expect, let's bring in Bloomberg White House reporter Jordan Fabian. And Jordan, when the president speaks around 8 p.m. tonight, what message will he be trying to send?
He's going to speak directly to the American people to try and convince them that the U.S. should send more money to Israel, but also to Ukraine, which is still locked in this war with Russia. There's been flagging public support for Ukraine, and we're at a time when there's rising concern about government debt. There's an isolationist strain of U.S. politics. The president wants to make the case that we should put those concerns aside because these fights concern the core tenets of American democracy and pose threats to democracies worldwide. So that's the message the president's going to be taking to the American people here later tonight.
Is he taking that message to the American people or to Congress, Jordan? The Congress that last time I checked still actually isn't functioning in the way it should.
Well, it's a bit of both in that sense. The primetime address definitely maximizing the exposure to the public, but you can be sure that members of Congress are going to be watching. And of course, like members of the Senate and members of the House who want it to function, this could create a sense of urgency to try and solve the yet never-ending saga to find a House Speaker, to try and break the paralysis in that chamber and allow them to get to work on things like foreign aid and a government funding package.
Well, let's talk about the message to the American people, because, of course, we're not just talking about President Biden. We're talking about Biden, the candidate. And, of course, we're about, almost 12 months out from the 2024 presidential election. How is this outbreak, the Israel-Hamas war, factoring into the campaign thus far, if at all?
Look, I think Americans tend to be most concerned with domestic issues, but in the sense that this conflict is going to, cause inflation to spike, cause general instability that could be bad for Joe Biden. But I will note that this trip to Israel was a chance for him to show some leadership on the world stage. You have a president where there are concerns about age and stamina going into an active war zone, showing leadership by meeting with President Benjamin Netanyahu, getting agreements on getting humanitarian aid into Gaza. So the White House is very happy with all those outcomes. And they know in the back of their minds that could help strengthen the perception of Joe Biden heading into 2024.
Jordan, Fabian, down there in Washington, here a look at the big address that the president plans for later tonight here. Of course, we know geopolitics sometimes can and cannot be a big election issue. One thing that always is a big election issue is the economy. The president currently trailing former President Donald Trump, presumed to be the nominee for the Republican Party's nomination. And he's trailing Donald Trump in several swing states amid skepticism regarding his economic message. That's according to findings from our inaugural Bloomberg Morning Consult poll of 7 battleground states. Bloomberg politics reporter Greg Courtney joining us right now to talk a little bit more about this. And the battleground states are basically your usual suspects here: Michigan, Pennsylvania, Arizona, Georgia. I know I'm omitting a couple here. But let's talk about that economic message, because it seemed for the last few months, all I hear out of the White House is Bidenomics, Bidenomics, Bidenomics. I haven't heard anyone other than the Biden administration use that phrase.
Well, Bidenomics actually started as an insult from Republicans, talking about the high inflation that we've seen over the past year or so coming out of the pandemic. And it was a little bit of political jiu-jitsu from the White House to try to rebrand that as President Biden's economic agenda, which would include things like investing in infrastructure, American-made semiconductors, but also, social services, a social safety net, revitalizing the middle class, unions, all these things. It's really sort of a broad and amorphous agenda, but it's also an agenda that's not particularly, or the agenda might be popular, but that Bidenomics branding is really sinking it with voters. Bidenomics not popular by more than 2-to-1 ratio. Yeah. Voters are saying that Bidenomics has been bad for the country, not good.
Well, I'm also curious, too. I mean, because the polling shows that a lot of the voters or at least in this poll, would trust Trump's shepherding of the economy over Biden's. The problem is, I know what Biden's economic policies are because he repeats that phrase every time he comes out. I'm not sure I've heard Trump, at least not in the last few months, really articulate an economic plan.
Yeah, President Trump is somewhat resting on his laurels. He will point to how good the economy was for the first 3 years of his presidency. That was before the pandemic hit in the 4th year of his presidency. And look, the stock market was up. We had near record low unemployment. Inflation was unheard of. And so that's his message, is that we can get back to the pre-pandemic Trump years. And not the post-pandemic years, which include 1 year of Trump and the rest, obviously, of President Biden. He has not talked a whole lot about what he would do, other than rolling back everything that Biden has done and going back to those Trump policies. Lower taxes, obviously, among them, lower regulation. Those are the things that he says will revitalize the economy.
And it seems, at least judging by the results of this poll, that that's resonating. This caught my eye, though. Suburban women, swing state voters, they're actually a bit of a bright spot for Biden. Unpack that a little bit.
Yeah, well, they sort of need to be a bright spot for Biden if he's going to win this election next year. He needs to overperform among women, and especially suburban women. And that's part of the coalition that helped him get elected in 2020. But then also last year in the 2022 midterms were a key constituency in helping Democrats maintain the seats that they maintained in Congress. As we know, Republicans took the chamber by only a handful of votes, and we're seeing how that's playing out now with them unable to elect a speaker. And so he won that demographic on issues like abortion and guns and those kinds of issues, but they're souring on him on the economy. Despite that, they're in the Biden column.
All right, Greg Courtney, also down in Washington there. Here, a look at some of the issues now surrounding U.S. politics and the big presidential election coming up next year. But right now, Katie, in the here and now, taking a look at the broader market, 42.79 on the S&P 500. That's a session low.
Yeah, session lows down about 0.8% there. A lot of those losses coming in the last 30 minutes, last hour or so. So I don't know what's flipped. Maybe Jerome Powell was on a delayed feed for some people.
On a delayed feed here. They should be watching Bloomberg News. I guess the good news is yield's a little bit more in check, kind of elevated in the middle of the curve, but not near the extreme moves we saw over the past few days. This is Bloomberg. Almost 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld.
We talk about really where this market has gone, up and down and back, up again. And right now we're down right around session lows for all of the major indices here in the U.S. here. If you're looking for a catalyst, I'm not sure you're going to find one, or maybe it's just the opposite. You'll find maybe like 10 or 12.
Yeah, that's the thing. Yeah, you take a look at the S&P 500 right now, hanging out around session lows, down 0.8%. Even though, as you mentioned before the break, I mean, the bond market relatively contained right now. You take a look at 2-year yields, they're actually lower on the day to the tune of about 6 basis points. But yeah, something's working through the stock market.
There was a little bit of a scare earlier today, 4.99 and change on a 10-year yield on an intraday basis here.
That was exciting.
We have not crossed the 5% Rubicon in, 15, 16 years. So it'll be interesting to see if we can get there. I should point out, you had a big downdraft today in European stocks. You also had a huge downdraft in Asian stocks. I think the MSCI Asia Pacific Index down about 1.5% on the day, and the CSI index over in China was down by like its worst day in like a couple of months. And I want you guys, if you could flip up the board here too, because there was also some interesting data here showing that Chinese investors have actually started to dump a lot of their U.S. holdings. You saw that with equities, and the chart that you're looking at right now are treasury holdings by Chinese investors. And I mean, you don't really need to know the numbers to see what's happening there. This has been a huge downdraft here, and there's a lot of speculation that some of this might be Chinese authorities trying to beef up its war chest to bolster the yuan. It's not quite clear exactly why, but of course they were a major buyer, and at least right now they're a major seller.
And I mean, that's what's percolating through the Treasury market right now. Who is going to be sort of the price-insensitive buyer? It's not going to be Chinese holders, it looks like. Japanese buyers, we also have a lot of questions about. So we'll see how that plays out. But let's talk about some individual movers today, because there's quite a few. I want to start with Tesla. You broke those earnings on air yesterday, and as I understand it, they were pretty bad, because you take a look at the reaction. Tesla shares currently off by about 10% after missing on profit, sales, and it sounds like margins were not so great either.
Yeah, the profitability is just not there. And it gets to the idea, everyone says, how do you value it? As a car company or as a tech company? Their earnings yesterday, those are car company results.
Those are car company results. Let's also talk about AT&T as well, another earnings story. A different story, AT&T advancing and then some on that cash flow outlook. It also beat on earnings. That's good for about 7.5% when it comes to the shares. So that's a good news story. And I also want to talk about Las Vegas Sands. This is really interesting. So they did post a beat. That was good. But the real reason the stock seems to be higher is they authorized a $2 billion share buyback program, their first since 2020.
I thought you were going to say like Taylor Swift was doing a residency or something at the Las Vegas Sands.
No, just buyback.
Just a buyback, just good old-fashioned buyback.
They reinstated their dividend last quarter, first time since 2020. So clearly management feels pretty good here. Yeah,
I remember when they pulled that a while ago. That was a big deal here. So I guess, reason for optimism here, a topsy-turvy day where Tesla's down 10%, yet AT&T is up 7-8% here on the day. All right, 1 hour away from those closing bells. Our cross-platform coverage starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. Joined right now by our colleagues Carol Masser and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, as well as those folks streaming us on YouTube here. A down day for stocks here, a mixed bag in the Treasury space. And just a few minutes ago, we had a chance to catch up with David Weston, who had a chance to sit down earlier today, Carol, with Jerome Powell, the Fed chair.
It's all about Jay Powell. What a great conversation that David Weston had with the Fed chair. And having said that, markets reacted tick by tick, it feels like, to what Jay Powell, initially some enthusiasm, maybe some calmness, if you will. And then you saw equities really move to some of their lows of this session, and yields once again kind of staying persistently higher, if you will, especially on that 10-year. What did Jay Powell say? Basically, he said policy isn't too tight. risk still high on inflation, just still too high. And he talked about those data points. If they continue to come out, it's going to be tricky to really pull the Fed back from continuing to raise rates, or at least prevent them from cutting rates anytime soon.
Yeah, pretty much also took a rate hike off the table for November. December is what everybody's focused on. I thought Romaine, he had really interesting comments about the labor market, saying that we have a very resilient economy on our hands and saying that the labor market is actually gradually cooling, though we have gotten a substantial amount of labor supply this year with people coming off the sidelines and going back to work.
Yeah, and he talked about this idea, too, how that data dependence, which he's still standing by, but he also made it clear here that there is a little bit more art to what's going on now than science when it comes to this phase of the rate tightening cycle and trying to determine what to do next.
And maybe rates are, doing the Fed's job for him.
Well, he acknowledged that. I mean, he basically said, David asked him that, and we've heard this from a couple other Fed members, but I don't know, does that mean they can just sit back and say, oh, okay, let the bond market do it?
They can at least take a breath, right, Katie?
Perhaps they could. What I really want to know is, when do we go from tightening financial conditions, yields doing the Fed's work for them, into maybe a moment of financial instability, or at least that fear entering the market. But let's talk about another big fear in the market for some of these food companies. We're talking about Ozempic, and one of the pieces on the terminal that caught my eye was Nestle.
Was Powell asked about this?
No,
How do you
no,
do,
and
that
I
was
wish we had.
A good transition, though, Katie.
I will say. I tried my best.
I will say.
Yeah, maybe. And in any case, I do want to talk about this because Nestle's CEO said that the company is actually, they're not too worried about sort of these weight loss drugs, because they're planning on developing products that will complement that. Specifically, they're already working on products that could serve as health aids during weight loss treatment. Yeah, so I don't know what that means.
Well, he specifically said, he's like, they're still going to buy bottled water, which I get. I don't know what the profit margins on that, but I guess that's good. But
I think high, Romaine. Yeah, I think they're high.
Well, don't you love when a CEO says, we're not too worried? It means they are so worried, and they are having.
We're not worried, but we're also developing products.
I think you are potentially seeing an upending of so many different things, because this class of drugs. I mean, we had a story yesterday by Madison Muller. These drugs showed they reduce heart attacks, strokes. Yeah. They could affect the heart, liver, kidneys in a good way. Alzheimer's, apnea. What if you have this drug that can change things so dramatically in terms of medical outcomes for individuals?
But and just on that point, though, I mean, the CEO directly addressed that, Mark Schneider. I mean, he kind of focused on Nestle's sort of broad array of brands, pet foods. They sell a lot of products that I guess technically you could consider nutritious. People still need nutrients, Carol Master, last time I checked. And I'm pretty sure they're going to have to drink water. Now, whether that's a multi-billion dollar
I'm all in.
business.
I'm 100% in on water. I'm just saying,
bold call there.
I think, but we talk about disruption, right? And there's a lot of things, and I think the food industry, many would argue, has not really been disrupted.
I also really question to what extent these drugs will disrupt the food industry. I know we've heard it a lot in recent quarters, but I wonder how much is being blamed on something that isn't yet widespread, and we don't fully know how Americans and people around the world are going to take this drug and how long they're going to take it. It seems like quite a bit of hedging from some of these companies.
Been out there for 20 years. Look what I'm drinking. Water.
Wow, there you go.
Just
Me too, Carol.
See?
Girl water.
I'm all in water.
Is that Nestle?
No. It's good old Bloomberg water.
Okay, so you're not actually boosting the economy.
All right, we got to run. We'll be back in less than an hour's time. We're going to continue our coverage on the markets across platform, radio, TV, YouTube, and of course, Bloomberg Originals. Join us at 4 p.m. Wall Street time.
Continuing our coverage right here on The Close, about 50 minutes until we get to those bells. We mentioned it a little bit earlier, but at one point in the session, we did see that 10-year yield right around 4.99 and change. Morgan Stanley's Vishal Khanduka sees the 10-year Treasury yield at 5% or higher as a buy. He actually says those will be great levels to get longer in your portfolio from a duration perspective under current conditions, adding, we'll be superbly in that overshoot category from the firm's fair value levels for Treasuries should yields breach 5%. Pleased to say that Vishal joins us right now. He's the co-head of Broad Markets Fixed Income over at Morgan Stanley Investment Management. And let's extrapolate a little bit more on that call. I mean, we've heard this from other folks here that 5% isn't necessarily the boogeyman that I think the market initially thinks it is.
I don't think so. Thanks again, Romaine, for having me on. And I think just to provide a little bit more perspective to that call of how we've been positioned here in portfolios and why I think Chairman Powell did a fantastic job, as usual, eloquently walking through what's happening in the bond market, how are they taking that information in, not only from the yields and the term premium coming back, et cetera, but also from the data dynamics or the economy that is proving to be quite a bit resilient. I think, but there was a very key message that he pointed out there was that they believe that rates at these levels, not only the front-end rates, but also the steepening that we've seen, the 10-year going and almost reaching 5% at this point, are quite a bit restrictive at this level. And they all need a little bit more time at these higher levels for those higher levels to seep into the economy. So yes, I think there is that frustration. I think that, this restrictive policy is not yet showing up in the economic data. I think we saw it after the three big data prints after the last meeting as well. Sorry, please go ahead.
Well, I am curious, too, just about kind of what also has been driving the move. Jay Powell was asked about this earlier by David Weston, and he kind of said what a lot of folks who have come on our program have said, which is the idea that this is less about the Fed right now, at least what we're seeing on the long end of the curve, and much more about that term premium. And I'm wondering then, does that 5% threshold, or at least 5-ish% threshold, does that sort of become for the market, I guess, what becomes not just necessarily attractive, but I guess I'm just kind of avoiding the word here, but does that become the peak?
It does not necessarily. Again, this is where I think we have fair value models, quantitative models, and qualitative assessment of the market as well, that we come up with some fair values of that, not only just term premium, but actual nominal levels of 10-year. Maybe we are not at the peak, but this is the level that we think that we should be scaling into some more duration, again, moving out from some of those front-end treasuries that we've been staying in. I think our biggest trade this year, not only being short the interest rate curve throughout the year, but also being in pretty significant amount of steepeners to stents was one of our biggest trade this year, at least in the last 3.5 months that we've put on. But at this level, we do think that the term premium is starting to get at attractive levels. Has it peaked? Maybe not. And again, that is one more thing that he eloquently pointed out, that it is very tough in real time, especially when you have the fiscal situation deteriorating in an unsustainable path. That maybe there's a little bit more to go, but we find these levels attractive to start scaling into some positions.
Let's talk about this steepener a little bit more, because so far we've really been seeing this being driven rather by the long end, that bear steepening as the 10-year yield continues to rise. Do you think that that's going to be the dynamic that drives us back to positive territory? And does that matter necessarily from your standpoint?
I think you're referring to the bear steepening. Yes, absolutely. I think that is where our conviction level is, that term premium needs to had to correct from negative 110 basis points that we had seen two stents to at some point. And I think the Fed has very repeatedly over the last probably, I would say 3 months, over the last 2 meetings at least, and then right after the last meeting as well, concertedly come out and said that this is where we are going to be deliberately staying at these levels on the front end. So the front end seems to be very well anchored. Again, we are not expecting the front end to rally unless there is some disaster in the market, and in the crisis from the Middle East erupts to be a lot bigger and broader, if you will. So yes, the back end will be driving the shape of the curve a lot more at this point.
And Vishal, we don't have much time left, but I do want to talk a little bit more about term premium, because now if you look at certain measures, we are back in positive territory. And kind of wondering, why now? What finally put us back in positive territory?
I think the bigger question that we ask ourselves, and which is, again, one top of mind thing, apart from rates, Fed policy, and what does that implicate for rates and spreads, is the correlation between the risk assets versus the risk-free assets. Again, whether it's correlation between treasuries and spreads, whether it's correlation between equities and bond. And I think Chairman Powell again stole the thunder and very eloquently mentioned, I think that is one of the things that is driving this risk premium. At some point, that correlation becomes a lot more negative, and then investors require a lot less premium, or that's where Romaine's question goes to. It's like, at what point do we peak out on there? And that is where we think it is an attractive time that the correlations are going to turn negative at this point.
Vishal, it's great to talk to you. Really appreciate your time. Our thanks to Vishal Khanduka, co-head of Broad Markets Fixed Income over at Morgan Stanley Investment Management. Now coming up as we head to the close, we'll get insight on the markets from Julian Emanuel, Chief Equity and Quantitative Strategist over at Evercore ISI.
And a discussion with Torsten Slok about the biggest downside risk to the U.S. economy.
And YouTube is said to be developing a tool powered by AI that would let creators record audio using the voices of famous musicians. All that and more coming up.
Is that legal?
I'm not sure.
Yeah.
This is The Close on Bloomberg.
Heightened volatility in markets here on this Thursday afternoon, a focus on the macro and also on the micro. Abigail Doolittle standing by with our Options Insight segment. And Abigail, you are taking a look at some of those micro issues.
We are, and the macro is pretty compelling, though, right now, given the fact that we've seen these massive swings after Fed Chair Jay Powell was interviewed and spoke with our own David Weston with the stock market now near session lows. But the micro is so important because a piece of this, of course, is Tesla and Netflix. To talk more about this, let's bring in David Bauer, Managing Director of Derivatives over at O'Neil Securities. Great to have you with us. You have so much experience on both the micro and the macro. But the implied volatilities on both Netflix and Tesla, they've lived up to them to some degree, but some of these moves are even bigger than what you were expecting.
Abigail, first of all, thank you so much for having me. It looks like the options market got the start to large cap tech earnings wrong. Netflix was implying an 8% move, and you could see it's up 16% today. It looks like the setup was short or underweight given the stock action into the print. And then with the subs beating and margin expansion, the narrative really changed. And then with Tesla, also, the implied move was roughly a 5% move. And the derivatives group at William O'Neil Securities was telling their clients to buy the move yesterday. And in Tesla, you actually got two moves, because yesterday you had almost a 5% move. And then today you have a 10% move. So you sort of won twice. And Tesla, we think that maybe the implied move was looking lower into earnings because the 10-day realized vol of Tesla was only 21 going into earnings.
That's really interesting in terms of some of these traders getting what happened wrong, especially Netflix, because that chart looked horrible and Tesla's chart looked like it would hold up, and now it's basically falling off of a cliff. So how do we play this forward? Because those, of course, are two of the Magnificent Seven. I have to get my math right there. But we have 5 more to go. I know that you think Amazon captures a number of the other big tech companies that are going to be reporting soon.
Yeah, so we like buying Amazon optionality into earnings. Amazon's going to capture Microsoft, Google, and Meta earnings.
And how is that?
Because Amazon reports towards the end of the week, and these companies report earlier in the week. So with Microsoft, you're going to get a read on the cloud with Azure. Okay. And then with Meta and Google, you're going to get a read on advertising. And we think if you buy the Amazon vol right now, it's going to be firm and probably rise into the actual event.
And so you like calls on Amazon, or?
We do like calls on Amazon. Third-party data has actually started to positively inflect on AWS. Okay. And if we do get a stabilization in AWS and maybe a positive acceleration, this stock could really rip, as you saw today with Netflix.
So if we do see that, that could turn into the micro, or excuse me, that micro could turn into the macro, since these big names are such a weighting to both the NASDAQ 100 and the S&P 500. Let's bring the VIX and the VIXN, that VIXN being, of course, the VIX on the NASDAQ 100, into the conversation. There continues to be a spread there. The VIX, I wish I had checked it right before we came up. It's probably closer to 20 again, but the VIXN I did see, and it's above 24. So volatility is heightened. Folks are, it seems, a little bit nervous that the Fed is staying the course, that they might hike again, especially after this last conversation. What are your thoughts around this?
I think if you want some protection to protect against large cap tech earnings, Middle East concerns, and also rate volatility, I was looking at some put spreads, Q put spreads for November 3rd, because those are going to catch 5 of the 7 Magnificent Seven. And then that comprises approximately a little bit more than 36% of the NDX index. So it kills a few birds with one stone.
And if we were also to speak about SPY, if we were to look at, a way to hedge, actually, so you're talking about hedging to the downside, if there's some kind of Tesla type action for some of these big tech companies. But what if we see more Netflixes? What would the play there be?
Again, I would just go the opposite way, and I would turn to call spreads in the same manner. I wouldn't be buying outright index options right now with the VIX and VIXN at these levels. I think you need to spread both sides.
Okay, great stuff. David Bauer of O'Neil Securities, terrific to have you with us and bring us some perspective on both this earnings season and this incredible macro backdrop that we continue to take a look at here for markets. Thank you for joining us for Options Insight today. And from New York, this is Bloomberg.
Well, you soon may be able to sing just like your favorite musicians, because Bloomberg has learned that YouTube is developing a tool powered by artificial intelligence that would let creators record audio using the voices of some of the world's biggest singers, Romaine. Again, this is according to people familiar with the matter, but this comes after, of course, YouTube has rolled out a suite of tools that basically leverage AI in some way.
And just to be clear, they're going to actually pay for this, right? Or like negotiate some agreement to use this stuff legally and not just take it like some of the other companies.
Well, that's a big open question. I love this language in the article on Bloomberg.com. The legal intersection of AI and creative works that include the use of people's names, images, and likeness is still being worked out, has already led to litigation.
Because there's been a lot of lawsuits. We saw one, I think, yesterday, Universal Music, what was it, Anthropic, over some issues with their AI tools as well. I guess the big question that I have, Katie, is that once they do roll this out, whose voice are you going to use?
It's like probably Drake. I don't know.
Drake?
Just for fun. If I put myself in Drake's shoes, and I often do,
Who doesn't?
I would probably be annoyed by this, to put it mildly.
Yeah.
I would want to get paid.
Well, if he's getting paid for it, I mean, think about it. If every time, do you think he'll just like follow you and be like, I hope Katie Greifeld sings today? And that's an extra 30 cents into his pocket.
I assume he's watching, but I mean, to put that question back on you, who would you pick?
I'm gonna cop out on this, and I'm gonna go the easy route, because you know who I would pick?
Who?
Taylor Swift.
No, I thought you were gonna Beyonce or something.
You thought I was gonna actually be honest?
Yeah.
No, absolutely not. Taylor Swift is in the zeitgeist.
Yeah.
Last time I saw, does she play for the?
No,
for
I don't
the Chiefs
think she
now?
actually
What exactly
plays.
happened? Because every time I turn on the NFL, she's there.
Yeah, no.
Like, I don't know. They haven't suited her up yet.
I mean, they should. Maybe that's the next step, because it feels
they have kickers who are like skinnier than she is. So I mean, she could play in the NFL.
And she looks like she could
She's
run.
got those long legs. I'm sure
she could run
she
pretty
could probably
fast.
get a good 40-yard field goal going.
Yeah, I think so.
Okay, all right. Well, I'm actually looking forward to these tools that come out and the absolute train wreck that it's going to cause when everybody realizes that their images, likenesses, and voices are being used
who
without
wins
their consent.
here?
No.
Lawyers.
Lawyers always win.
Yeah,
and
probably.
I say that as somebody who comes from a family full of lawyers. All right. What's the market doing, Katie Greifeld?
Let's look at it very quickly. It's still down, of course. Another down day for equities. The S&P 500 continuing its descent, now down about 0.9% as bond yields continue to rise.
Hey, but what about Netflix? 17% gain.
I'd take it. This is the close on Bloomberg.
This is the countdown to the close. Less than 30 minutes, Katie, until we get to those closing bells.
And it's another ugly day in the market. You take a look at the S&P 500 right now, down about 0.8%, and we're really talking about a big, broad sell-off here. You take a look at the circle behind me, it's almost all red. Your only bright spot really is communication services, up by 0.4%, but really that's mostly just Netflix having a fantastic day after reporting earnings. You go down the list there, and towards the bottom you have financials, real estate, and consumer discretionary is your biggest loser day, off by 2.3%, Romaine.
Let's take a look at some of the individual movers here. Obviously, the biggest mover on the day, at least on a percentage basis, that goes to Netflix. Amazon had been significantly in the green. In fact, at one point on the day, that was actually the biggest point contributor to the S&P 500 gains. But as we speak here, flipping into the red. How's that for some drama? Rollins, though, really taking it on the chin, down 10%. Keep in mind, this is the pest control company. It actually doesn't report earnings until next Wednesday, but one of its UK rivals, Rentokil, came out with earnings, and they have a big business here in North America, and they said customers are pulling back big time, and so a lot of investors starting to sell off Rollins as well. Those shares down 10%. Nokia, also another European story with big implications for what's going on here in the U.S. That company cutting more than 10,000 jobs. And it was interesting. The commentary was really about capital spending and how most of its customers in the U.S. and Europe are really dialing back that capital spending in a big way. Now, obviously, this is very specific to 5G and telecom, but once again, you're seeing a lot of names in that space also move lower. Nokia's ADR is down almost 6%. And Eli Lilly can't really get a break here, down about 3% here on the day. But of course, we're talking about a stock that at one point was up something like 60% here on the year on the back of some optimism when it comes to its weight loss products here. I do want to talk a little bit here about what's been going on with Katie, back to you.
Okay, all right. Let's get more perspective on the outlook for the U.S. economy, because right now, Apollo chief economist Torsten Slok, he's outlined 10 downside risks. They include households running out of excess savings, student loan payments restarting, sticky inflation forcing the Fed to tighten too much, delinquency rates rising for credit cards, default rates rising for high-yield bonds and loans. So a lot to be worried about, but I'm thrilled to say that right now Torsten Slok joins us. And Torsten, I actually want to start with number 10 on your list, which is long-term interest rates rising for non-economic reasons. That's really, it seems to be front and center in the market's mind. Will you just walk us through what some of those non-economic reasons could be?
Yeah, this is really important, Katie, because there's a very important debate going on. Why are rates going up? And rates can go up for two reasons. Long rates can either go up because Fed expectations are changing. In other words, if we suddenly were pricing in many more rate hikes, then of course long rates should also be going up. But that's not what has happened in the last several months. Instead, it is all these non-economic reasons why rates have gone up, or in different words, it's the term premium that has driven rates higher. And what are those non-economic reasons? Well, first of all, the US had a downgrade in August on the sovereign side. That's, of course, been a major change to what's going on in treasury markets. Also, we have seen significant issues with issuance of treasuries. Next year, going to grow quite significantly. On average, issuance of treasuries across the yield curve will be up 23%. There's a lot of debate in markets, and including on your shows, about what does all this supply of treasuries mean. And more importantly, we also have another list of things like Japan exiting yield curve control. We have China is having lower exports. That means fewer dollars to recycle. So there is basically a laundry list of all kinds of somewhat unquantifiable explanations why rates are moving up. And the most important issue in this discussion is if we finally get some bad data, say non-farm payrolls or say jobless claims, if rates don't go down, it will reveal that it is all these non-economic reasons why rates are moving higher. So that debate about why are rates going up, is it because of the economy or is it because of these other things? It does become really, really important in markets.
Well, when you put all of that together, what's the potential ceiling here for when you think about how far yields could actually rise and you think about the economy at large so far resilient to those higher rates? At what point does that start to break?
Yeah, that's also really important because think about it. For the last 5-6 months, the market has been pricing that the Fed is very close to the peak. That hasn't really changed. That's still the view today. We are now debating a little bit after retail sales. Well, maybe rates will go up and the Fed will hike again here in December. But broadly speaking, markets have still had the view that the Fed is not going to do much more than what they already have done. And still, long rates have continued to move higher. So to your question, Katie, what the really important question then becomes is, well, if the driver of rates has not been a change in the economic data, if it has not been a change in the outlook for the Fed, but has instead been a change in how the market views issuance of treasuries, how the market views Japan exiting yield curve control, the sovereign downgrade, even some issues about whether the market is seeing this as an unwind of the basis trade, some more technical reasons. Those other reasons might begin to play a role. In other words, even if the data begins to weaken, issuance is still a problem going into next year. So therefore, it does become quite important to your question, what is the ceiling? It depends a lot on whether rates are actually driven higher by the economic data getting better, which doesn't seem to be the case, or whether rates actually are going up for this laundry list of other things that are the causes of why rates might be moving higher.
I do want to talk a little bit more, though, about some of the, I guess, canaries in the coal mine, if you will, Torsten. Everyone's still looking at the credit market, and by credit, I'm talking about consumer credit right now. The idea that as a whole, when you look at it, delinquencies and some of the other charge-off measures, as a whole, they're actually not that bad relative to history. But then when you sort of break it out between some of the big banks versus some of the small banks, and you look at what the small banks are holding, it's eye-popping.
That's absolutely right, Romaine. So here the issue is, I mean, what we should do in markets and what we in my group spend so much time on is trying to figure out what has been the impact so far of rate hikes on consumers, on corporates, and on banks. And if you look at consumers, exactly as you're highlighting, yes, we are seeing delinquency rates going up, and in aggregate, it may not look like it's going up in any significant way, but if you start looking at the New York Fed data for what's happening to delinquency rates for people on credit cards in their 20s, in their 30s, and in their 40s, what's happening to delinquency rates on auto loans for people in their 20s, 30s, and 40s, you're beginning to see that the level of delinquency rates at the moment is actually close to what we saw in 2008. So that gets to the point that even before the Fed has succeeded with pushing the unemployment rate up, we are already seeing, in particular on the consumer side, a rise in delinquency rates, as you're highlighting. Looking also at default rates for high yield, also going up. And likewise, bank lending is also slowing down in the weekly data. So the textbook would predict that the economy would begin to slow down by reacting with more people falling behind on payments on the consumer side, more corporates going bankrupt, and banks slowing down lending, and that's exactly what we're seeing in the data.
Do you sort of buy into this argument here that when it comes to economic conditions and the consumer, that there is kind of this tale of two cities where you have lower and middle income people that are actually starting to struggle, but you still have this huge cohort of upper income people that are comfortable and still spending, and that right now is the main pillar that's supporting this economic growth?
Yeah, so that is absolutely, I agree that here the issue is that we still have a lot of excess savings left by using the San Francisco Fed's methodology is roughly around 500 billion that's left to be spent. And if the burn rate of that is about 80 billion a month, you get that in the next 3, 4, 5 months, we will get closer to the point where that excess savings will be coming down. And you're right, there are some distributional issues about where those savings are located. But combined with the households running out of savings and student loan payments starting here about 2 weeks ago, we are still seeing a fairly significant amount of downside risk, both from the Fed hiking rates and from consumers running out of excess savings and from student loan payments restarting. So the outlook for the next 3 months is more to the downside for the U.S. overall.
Torsten, always great to speak with you. Hope to do it again soon. Our thanks to Torsten Slok of Apollo. Now coming up on the close, Blackstone shares down about 7.5% after it misses its third quarter results as it grapples with high inflation and high interest rates. It's our stock of the hour up next. This is The Close on Bloomberg.
Welcome back to The Close. It's time now for our stock of the hour. A closer look at Blackstone. Shares down more than 7% after missing third quarter results. Sonali Basak had a chance to sit down with the president and COO, John Gray, and asked him when the slowdown in deals will start to turn around.
I think long rates have now moved quite a bit. And so that's going to lead to some tightening here, further tightening. But what investors want, of course, is a bit of stability. And I think ultimately we will find at some point some stability in marketplaces, particularly in treasuries. When that happens, I think you will start to see transactions pick up again. They are at a muted level, but it doesn't stay like that forever.
Blackstone President John Gray there, Sonali Basak joining us on set right now, fresh off the heels of that interview. And is the general message here that what's ailing them is relatively temporary and, more importantly, relatively linked to the trajectory of yield so far?
Yeah, absolutely. For him to tie it so directly is very important. For Blackstone, listen, it's more than $1 trillion in assets under management. The thing is, it's a bellwether for the rest of the industry. And what's interesting here is you have assets under management missing expectations, inflows missing expectations, and investment performance, it's actually up across the board at most of the business lines for the first 9 months of the year, but down in real estate, opportunistic and core real estate. You hear John Gray saying things are going to start to slow down. on some level, slowing down could mean they could start putting money to work and lower valuations. But on another level, if they're so volatile, it's hard to find financing. And other businesses across all of Wall Street, private credit, private equity, and otherwise, are going to have a hard time until that starts to happen.
Yeah, so it seems pretty bad across the board for Blackstone. But I mean, the big question, not just for Blackstone, but for a lot of the banks you cover as well, when do deals come back?
Yeah, when do they come back? James Gorman this week had a funny way of putting it to analysts. It's like there are green shoots, but somebody forgot to water them. And so there's no sense of when they actually start to come back. Privately also this week, I've had private credit investors saying they're really feeling the pains of the deal drought because eventually they have to finance them as well as the banks having to finance them. So again, until the market, the underpinning market, the treasury market starts to stabilize, it's going to be really hard to see things done at scale.
All right, Ananya Bostick, of course, our Bloomberg Wall Street reporter, sit down a little bit earlier here in the day with John Gray over at Blackstone. The shares are really taking it on the chin, one of the worst days they've had in a year. And in fact, that's been the story for a lot of individual movers in this market today. We mentioned it a little bit earlier at the top of the hour, session lows. Well, now fresh session lows across the board.
Session lows across the board. And it's interesting, of course, we're just starting to see earnings season kick off. And we've been talking about how this is such a macro-driven market. But now that we actually have some numbers to dig into, it's earnings once again driving a lot of these individual names. And for some of these individual names, it's not too pretty.
It's not too pretty here. And it gets back to the yield environment, right? I mean, higher for longer. Everyone's bought into that because that's what Powell tells us, right? And the idea is that you have to adjust your business for that new environment. Now, some of these companies will certainly do that. But there are a lot of companies out there that look like they're flailing out in the ocean.
Absolutely. And think about where those are. There's a lot of concerns about small caps right now, those smaller companies who have to really actually deal with their maturity walls. They have to refinance their debt. You think about higher for longer, and that's a painful proposition.
All right. Katie Greifeld and Romaine Bostick here helping you count down to these closing bells. Julian and Emanuel are going to be joining us in just a second. Chief Equity and Quantitative Strategist over at Evercore ISI. Stick with us. This is The Close on Bloomberg. This is the countdown to the close. Romaine Bostick here, joined right now by Scarlet. She joins us, of course, every day at this time to help count us down to those closing bells and take us beyond the bell as well here. Another bad day here for equity markets. We're off the session lows here, but still red all across the screen, Scarlet.
Yeah, and the losses really deepened after Powell stopped talking as well. I mean, when you listen to the contents of what he said, it feels like much ado about nothing, meaning pretty much what investors and the market had expected. But you look at stocks, they've taken a leg lower, small caps in particular, really feeling the toll of those higher rates more. The 10-year yield is higher, the 2-year yield is somewhat lower. Did we learn anything new, Romaine?
I don't think we learned anything new, and I'm not even sure what he said really moved the market. I mean, and I thought, I think it was Abigail Doolittle was on with us a little bit earlier. The idea here that while the macro is, of course, still driving things broadly, that there have been a lot of bad earnings, and or at least earnings that didn't really live up to expectations.
Right, not great earnings.
And that's pressuring sentiment as well here. So, I mean, sure, Powell saying that we're going to stay higher for longer, or whatever the phrase he used, that certainly damps sentiment. But then when you start to go through these earnings and the forecast for that matter, and realize that you're not going to get a reprieve there, at least not anytime soon,
right?
That could be having
disinflation is certainly the trend when you look at the economy, but not getting to 2%, and the fact that prices are higher overall are really taking their toll on corporate earnings and the corporate outlook. CSX will be reporting after the close. It's going to face the dual pressures of higher wages and higher fuel costs.
Absolutely here. But the bright spot here, if you were lucky enough to buy Tesla yesterday, you're up 17% on the day.
There you go.
That is your one and only bright spot out there. Julian and Emanuel joining us right now. A bright spot for us here as we count you down to the close. Chief Equity and Quantitative Strategist over at Evercore ISI. And Julian, I do want to start off just with the broader market for a moment here, because we had an S&P that opened up by, what was it? Let's get this right around 4,300 or so. At one point, it did dip down into that 4,200 level. And there's a lot of talk about the potential for a retest of some of those earlier lows that we saw, and whether that retest is kind of the opening that maybe the market wants to see.
So what the key here is, when you think about where the market indices are, we're not necessarily going to be enthusiastic buyers when you get to 4,200, because frankly, when you look at it, the small cap Russell 2000 is very, very close to the 2022 lows. And we would expect that kind of stress, and you're seeing it in how the VIX is closing today. That kind of stress is probably going to cause another bout of volatility in the marketplace, ultimately that will provide a buying opportunity, but you really haven't seen a true volatility spike in well over a year. And that's the kind of event that, particularly when you think about the mutual fund tax loss selling season in October, and then the public's tax loss selling season. And last year it was absolutely epic in some of them.
What does that do to investors in terms of where does that drive them? Is that going to drive them back into the Magnificent Seven? Is that going to drive them more deeper into short-term treasuries and money market funds? What?
So it's incredible the move towards cash and cash alternatives. It just continues apace. And I think when you think about the macro disruptions and the challenges in this world, whether it's Israel and Gaza, or Ukraine and Russia, China, or the incredible dysfunction we're seeing in the House of Representatives right now, this kind of uncertainty causes a move towards cash.
You mentioned the Russell 2000. Is its moves lower a leading indicator, a lagging indicator, a coincident indicator? How do you think about it relative to other assets?
Well, we don't know that it's in this muddled environment, particularly driven by the idea of yields ratcheting to where they are. We'd say the lead indicator is the 10-year yield right now. And you're so close to 5% that there is a potential for a psychological change there. But again, the Russell has been the weakest part of the entire market, and certainly at a minimum holding the rest of the market, Magnificent Seven or otherwise, from making further advances.
As Romaine points out, now the focus turns to earnings, and the earnings have not been fantastic. We're going to hear from CSX later on this afternoon. You say industrials are kind of the canary in the coal mine here in terms of recession signals.
They are. If you think about it, right, it's kind of unique, given everything we've known about the fact that China has been as uneven as it's been for the majority of this year, that the industrial sector would have made a new all-time high this August, a year and a half after the S&P and the NASDAQ made their all-time highs, and has since basically turned sharply lower. We've heard idiosyncratic commentary out of a number of transportation companies. Obviously, high oil is playing into this. And this, to us, is one of these signs that further weakness in that sector really is a harbinger of a likely economic slowdown, which we don't see in the data right now. I mean, weekly jobless claims this morning, under 200,000. The Fed would never have predicted that 18 months into a tightening cycle.
I feel like a lot of times when we talk about the current economic conditions here in the U.S. and market sentiment as well, we look at it almost domestically, basically, what's going on here. Things are well. We know China, the second largest economy, is on the back foot. You now have what could be a more significant war in Israel and in the Middle East, depending on what happens there. You still have an unresolved war in Ukraine, and as you mentioned, we have a Congress that right now has no leader, at least in the House of Representatives.
Yeah, and when you look, earnings may be okay. And in fact, when the year is over, you may have sort of even, maybe up 1% versus last year. And there's a potential that if we avoid recession next year, which is not our base case, by the way, that earnings could rebound. Still, estimates are too high. But the point is, at almost 20 times 2023 numbers, given where interest rates are and given the geopolitical backdrop, stocks seem like they're not discounting enough risk at the moment.
Go ahead.
Oh, no, that may be the case. I'm glad you bring up both interest rate gyrations and geopolitics. If the 10-year yield is the leading indicator here, one sector you say can withstand all of that, or at least not show the pain as much, is healthcare. Are we going to see that reflected in the results that they do give us?
Well, we think that there'll be uneven results, which actually, if you think about the group in general, there's been an incredible bifurcation between thinner for longer stocks, GLP-1 names, and everyone else. And actually, that's caused the generalists to shy away from investing in the group. But traditionally, healthcare stocks don't care as much about geopolitics or interest rate gyrations, and we would expect them to return to that sector into earnings season and beyond.
Okay. All right, Julian, always great to talk to you. Great
You.
insights as always. Julian,
Dinner for longer.
Dinner for longer. I like. I'm going to steal that. Julian Emanuel over at Evercore ISI, helping us count down to those closing bells. And I mean, we were talking earlier, Scott. I mean, just to his point there on the dinner for longer. Some of the other companies, the ones that were supposed to be sort of killed by these drugs, are now pushing back. Interesting comments by the Nestle CEO earlier today, saying, hey, "Look, hey, we still got pet food, we still got water, and we have food with nutrients in it."
People will still eat potato chips. They'll still eat snacks. That's not going to go away. Just maybe not in the volume they did before, or maybe they'll feel empowered to eat in even greater volumes.
All right, higher for longer, thinner for longer. Romaine Bostick and Scarlet Food here, moving closer to those closing bells. Our full market coverage right here on Bloomberg, coming up next as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Food. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Stenovic. Welcome to our audiences across our Bloomberg platforms, television, radio, originals, and, of course, the folks still streaming on YouTube.
Still?
Still.
YouTube is huge.
What do you mean?
Yeah.
They keep on streaming. They
It's
keep
the
growing.
future.
Yeah.
I love it. Yeah.
Have you heard
absolutely.
about those streaming services? Netflix, Apple Plus, you know, all those things?
No, never heard of them.
He's a cable guy.
He's a cable guy. I love it. He's got like probably a TV at home with those little, ears on it.
No, I don't. I don't have cable. I don't have anything.
Do you really not?
No, I just keep our radio,
Cord cutter.
our dial radio tuned right there to Bloomberg Radio.
1130 here in New York.
Stenovic
Thank you, Romaine,
and
for
Carol
doing
Masser.
that.
every
Thank
day.
you so much for that.
Absolutely.
Hey, did you guys see what's going on with money market funds? I was just kind of like going through a couple of stories. Money market funds seeing the biggest weekly outflows in 15 years. So going back since September 2008. This is through October 18th. I thought that was pretty significant.
Did you say outflows?
Yeah, about $99 billion left U.S. money market funds in the week through
I
October
thought everyone
18th.
was buying money market funds because.
What does that mean?
All right, that's an interesting story. Hey, Scarlett, I was just looking at the S&P 500 and what happened today, and searching for direction much of the day, swinging between gains and losses more than a dozen times. But then at about 1:30 today, just moved decidedly lower, and it's been there all day.
And we've seen volume pickup as well, certainly in the S&P 500. Notably, volume in TLT, the ETF that tracks longer-dated treasuries, really picked up. It went above average at about 12 p.m., right when Powell began speaking.
Yeah, absolutely. And I mean, look, these market ructions and the volatility around it, he was asked about that by David West, and he said, the Feds keep an eye on it as they should, but at least for right now, he seems pretty comfortable not actually taking any action on it. The Dow Jones Industrial Average lower on the day by roughly about 260 points as we wait for these numbers to settle. A close right around 33,412, down 0.8%. A similar move lower of about 8 to 0.9% for the S&P 500 that pins it right around 4,277 and change. The Nasdaq Composite down more than 100 points or about 1% on the day. And your laggard, the small caps, the Russell 2000 lower by 26 points or 1.5%.
Yeah, that heavier volume, and you are seeing investors really kind of run away from everything. Taking a look at the S&P 500, Scarlett, you've got 428 names in the S&P 500, lower on the session, 74 higher and 1 unchanged.
Yeah, and that is reflected when you look at the sector performances as well. Let's start with the outliers. Telecom stocks, which only basically has 3 or 4 members, up 2.6%. That is AT&T as the big gainer there. Software and services and media entertainment, they're notable in that they did not decline. On the downside, Tesla dragged the auto and components index off by 8.1%. Real estate investment trust also losing about 2.4%. And diversified financials, that's really Discover and Blackstone dragging that index lower as well.
All right, guys, let's get to some of the individual gainers. Netflix, certainly among them. We were just talking with our Geeta Ranganathan. I mean, this one pretty much holding on to all of the day's gains at its highs up 18%, finishing the day with a gain of 16%. Top in the NASDAQ 100, top in the S&P 500. We know what it is, that big subscriber add, 8.76 million customers added in the third quarter, far exceeding analyst estimates. Best quarter for subscriber growth in years. And also the cash flow number. I mean, Netflix knows the streaming business, knows how to do it, knows how to generate a lot of cash. So definitely an outperformer. Dexcom, this continues to be on my radar, up another 2.2% in today's session, up 15% in the past 5 trading days. Maker of glucose monitoring systems, it's been under pressure because of this new class of weight loss drugs, concerned about everybody else going to get hurt in the process. Barron's earlier in the week saying this has been overdone. And you also had had outperform rating come from Leerink Partners earlier in the week, and they put a $110 price target on the company. The stock closing at $86 today. Just want to mention AT&T. This was top in the S&P 500, also higher on the day, up almost about 6.5% here, raising its free cash flow guidance for the full year after posting mobile subscriber gains and profit that beat analyst estimates. So some really big outperformers in a day, a market day, equity market day, Tim, that was really all over the place.
Yeah, also some big underperformers. You got to start with Tesla, the worst performer on a points basis in the S&P 500, finishing the day down by 9.3%. It was a miss across the board, whether you're talking about profit, sales, or margins. And expectations were low already going into the quarter. We should note, we did speak to Dana Hull just a few moments ago. She described Elon Musk's mood on the call yesterday as dour and reminded us that he slow-walked the factory in Mexico and described Twitter as being an albatross across his neck concerning potential customers for Tesla cars, now associating him with everything that's happening at Twitter.
Was there a way to avoid that?
Not buying Twitter.
Okay,
I think
just
it's the way
checking.
to avoid
While you're talking on Tesla, before you move on, actually some breaking news now. Toyota actually striking a deal with Tesla to use their superchargers, and I guess maybe that could end up being a material boost at some point, Tim. Remember, they struck those deals, I think, earlier this year with GM and Ford. Yeah. So kind of interesting that, maybe the secret sauce for this company isn't just selling cars, but kind of relying on that infrastructure that it's built out.
So now you can go charge your Mach-E there soon.
I mean, I would hope Elon would know that. I mean, if you got off Twitter, maybe you would see that.
X is what it's called, I think.
X, I'm sorry.
Let's go to Blackstone, the next decliner that I wanted to point out is notable today. Reported a 12% decline in quarterly profit to shareholders today. Higher interest rates, a pullback in deal making, hurting profits, finishing it down by 7.9%. And then finally, shares of Canada Goose actually plunging today to an all-time low, fell nearly 10% before closing lower today by around 4.4%. We had two different analysts, Wells Fargo and TD Cowen, recommending investors move to the sidelines. Warmer than usual fall weather not helping, consumers pulling back, not helping at all, but a record low for the company today.
All right, let's take a look at the yield space. There was a lot of activity there, a lot of it on the longer end of the curve, with the 30-year yield up about 10 basis points on the day, I should say. And that 10-year yield going to close out the day only up by about 6 to 7 basis points here. But we should point out, at one point on the day, earlier in the session, it did reach 4.992. And of course, everybody looking for that 5% threshold. We talk about what is now basically a 16-year streak where we've been below that 5% threshold. So there's a lot of concern here about what happens when we get to that threshold, and more importantly, if we go meaningfully above it. And we actually spoke with Vishal Khanduka over at Morgan Stanley. He actually said this could actually end up being the buying opportunity that a lot of bond investors are looking for. The idea that there is sort of this sweet spot here where you can sort of lock in that yield and still get some good price appreciation should yields start to come back down soon.
I talked about that with Michael McKenzie earlier today. I mean, there is a silver lining to all of these rates moving higher, and that's rates moving higher. The fact that you can actually get, 5% on a 10-year, for the first time in a really long time.
And everyone's asking. I mean, it's, you always talk about sort of when you get these market inflections is, the old story was like when the shoe shine person or the taxi driver starts talking about it. And, it's funny. I mean, I got family members asking me about buying 10-year treasuries, and I'm like, I don't know.
You're like, I don't know. I just talk about it all day, every day. But I'm not going to tell you what to do.
I talked about my 20-year-old, like putting, opening up an account. She's like, Mom, I did a money market because, I can get like 4 or 5% on it.
Smart.
Like,
there you go.
It's kind of interesting.
Taught her well.
Sounds like an economics major.
I do wonder, though, the flip side. That's great, right? If you want to kind of lock something in longer term without the risk, but at the same time, you do worry about this higher rate environment, whether it's on car loans, auto loans, on the mortgage industry. You do see certainly that impact and that slowing down.
All right, I want to just jump in here for a minute because CSX is the loan company that we're really monitoring here, reporting earnings. And here, the stock is lower in after-hours trading after EPS for the third quarter missed analyst estimates, 42 cents, a penny shy of the consensus estimate. Revenue did beat the consensus estimate. It was down 8% from last year, but at $3.57 billion was slightly higher than the expected $3.55 billion. Operating income of $1.3 billion matches the consensus estimate, and operating ratio was actually 1 percentage point higher than what a lot of analysts had anticipated. It was 63.8% for the quarter.
It's interesting. I mean, we've only gotten a smattering of companies so far, at least in the S&P 500. I think about 60-something companies so far have reported. But of course, we know that picks up in a big way next week with almost 200 companies. And I guess the question is sort of like, are we hearing the same thing from these companies? I know the numbers are going to vary, but when we talk about their commentary about economic conditions, about consumer spending or business spending, are they all singing from the same hymnal?
Yeah, higher fuel costs, it comes up quite a bit, certainly for the industrials.
Yeah, I'm looking at CSX, their press release, and they are talking about we are encouraged to see improving sequential trends in some of our key end markets. They talked about their merchandise business remaining solid, our coal operations delivering strong volume growth. So that to me sounds a little bit optimistic.
Did you say the part about encouraged to see improving sequential trends?
Yeah.
Carol?
Yeah.
Okay, so that's something.
Didn't I say that?
Yeah,
I'm glad you listened to me.
She did say it. I was actually listening for the first time, so I heard it. Yeah.
For once in your life.
But what becomes the next catalyst? I mean, we talk about Jay Powell, who was speaking a little bit earlier today, Carol, and then, of course, we have all those earnings. Is that it? Is that it?
I think we're all waiting for rates to really peak out, top out. And at this point, we went from talking, 5%, and now I'm hearing kind of a drumbeat of maybe 6%. So
Ooh.
I think that's what we're trying to figure out. How high and then how long do we stay
Katie
at those
Kaminsky's
rates?
been saying that for months at this
I'm
point.
holding out for like 8 or 9%.
Oh boy, I mean, 5%.
I would literally liquidate
Are you really thinking
my
8 to
portfolio
9%?
and just lock that in, given my age. Yeah,
5% is increasingly becoming
old,
the normal.
Carol.
It's the when,
need
not
stability.
if kind of question here.
And income.
No, it's
He's still going on about his high yields.
And that's the one thing I think about what Dana Hull said about Tesla. I know we've got a wrap here, but it's just interesting. She's saying, Tesla is this company that has been living in a, free money environment, and now they're in a very different environment, and that is something that Elon Musk is trying to get his head around. All right, guys, I've got David Weston. I got some more important things to do.
Interesting.
Continue this.
I had a retort to that. Do we not have time?
We got to run. Nope. Okay. Tomorrow we can do it. All right, that's a wrap for our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We will see you again tomorrow.
Coming up here on The Close, a look at TSMC bouncing back here. The chip maker saying they themselves are seeing a recovery in sight from the post-COVID slump. We're going to talk a little bit more about what they had to say and whether it actually applies to the broader chip industry. This is Bloomberg. Interesting day here in the markets. We saw stocks on the back foot once again, and once again, of course, yields were driving the story. The chart behind me, though, shows you some of the differential that we're seeing in this market between the big gains, the outsized gains that we've seen in big tech, whether it's that Magnificent Seven or even a broader cohort. The blue line there, looking at what's been going on in the yield space on a price basis, and you can see that differential here, that this has actually been the buffer for the market if you want to remain and invested in equities. That's the trade that's been working for a good portion of the year. Did not actually work today. Only a couple of the Magnificent Seven even managed to poke into the green here on the day. And of course, Tesla, the big one there, was down 10%. The net effect of it was an S&P 500 and a NASDAQ down about 1% on the day. And some of those numbers, really start paying attention to numbers like 4,200, numbers like 13,000, because a lot of us strategists that we're talking to now are saying those numbers are back in play. A retest of some of the lows that we had earlier in this year, and even some of the lows that we had back in 2022. A retest is some strategists say we need to see before you see more confidence and conviction in the trade. Magnificent Seven as a group down 1.5%, and pharmaceuticals and a lot of the biotechs also moving lower on the day as well. That brings us back, of course, to the yield story, and everyone right now looking at this yellow line, 5%, a level that we have not been at since 2007, and it's causing a lot of agita here as to what it exactly means. 499 and change. We reached that level early in the session, and most people think it's a matter of when, not if, that we reach that 5% threshold. But Scarlet, we were speaking a little bit earlier with one of the folks over at Morgan Stanley, who actually said that could be a big buying opportunity for a lot of bond investors that really do see a balance there between what they would get on yield and some of the price appreciation they would get once those yields presumably start to fall.
Yeah, and when we finally get there, maybe that'll remove some of the uncertainty of when will that actually happen. All right, so of course we will keep an eye on 10-year bond yields for you, but we're also keeping an eye on, within the tech sector, the chip makers. And the worst could soon be over for these companies. At least that's the prediction from Taiwan Semiconductor. TSMC reported sales and capex that topped analyst estimates. The foundry chip maker is expecting tech demand to recover from its post-COVID funk next year. So let's bring in from San Francisco, Bloomberg Technology co-host Ed Ludlow. Ed, I look at TSMC's ADRs. They rose about 3.7% in trading today, and it's also given a boost to ASML, which is one of its suppliers. Yes. But the Philadelphia Semiconductor Index on the whole declining. So the rest of the chip space did not get much of a lift from this.
Yeah, look, we've heard the idea that the chip market has or will bottomed out before, that the worst is over. The thing about TSMC is that, as you said, it's a contract manufacturer. It makes the physical chips for everyone else that we talk about that designs them. And there's kind of two stories here. One, the mainstay of their business is PC and smartphone. And so they have good visibility to see their customers working through inventory and start ordering new chips. That meant that their sales forecast gave us confidence in the commentary that the market's bottoming out. But the CapEx commitment also indicates that they're anticipating a need for additional capacity and their willingness to invest in it. And so in this world of looking for crystal balls, TSMC of all chip names saying, OK, we think the market will improve, particularly in those two specific end markets, has given the market some confidence.
There's also the other issue here right now, Ed, obviously, and it's kind of right there in the name, being a Taiwanese company and having those ties to Taiwan, having ties to mainland China. The geopolitical risk have also caused some investors to pull back as well.
Yeah, and you look at some specific fund managers. TSMC is like the most held stock in Asia across many funds, right, on the institutional side. But in terms of the specific China exposure and the US export curbs on technology, TSMC basically said in the near term, this is limited and manageable. Think about all of the different kinds of chips that TSMC makes. They are at the cutting edge, 3 nanometer, making the A17 processor that goes into the Apple smartphone. But those chips that are caught by these expanded technology export curbs, we're talking about AI chips. They do manufacture for NVIDIA, but 3 nanometer fab is a very small portion of what they make. Long term, there are lots of questions of whether they have to stop making those chips at all.
I am curious, Ed, but did they address this on the call? Because it's easy to say, OK, we make this. Right now, it's not covered by this. But as NVIDIA sort of alerted the market to earlier this week here, is that can change pretty quickly. And if it does, you can end up being caught behind the 8 ball as an investor.
Oh, those weren't my words. I'm literally verbatim stating they said near term, it's going to be limited and manageable. Longer term, they reevaluate. And the longer term part is just as I said. Right now, some of their production is impacted by the curbs specifically. The question is, what kinds of chips continue to be caught about it? Those that NVIDIA are asking TSMC to make for them that have their destination in the end market of China. And that's not clear right now. Remember that NVIDIA had made a specific for China chip, the A800 and H800 GPU. Those are now caught. And so that will impact TSMC's future planning for capacity planning.
Yeah, well, clearly TSMC benefited from globalization, and now as the world deglobalizes and there's more economic nationalism, it's starting to feel the pain as well. Ed, you also reported that OpenAI, the company behind ChatGPT, is in talks to sell existing employees' shares. So this is a private placement at an $86 billion valuation?
Yeah, this is on the secondary market, a tender for blocks of shares, either through SPVs. But in this event, the company's not raising money. They're just giving liquidity to staff who have got part of their compensation in stock. But it is interesting because the range on the valuation that these shares are priced at is going up and up and up. You know, we've seen reports of a range of 80 to 90 billion. What we're told by sources is there are now blocks of shares on the secondary market on offer, valuing OpenAI north of $86 billion to $90 billion. It's creeping higher and there's demand for those shares. But it's a company that's like going to do $1 billion of revenue this year, which is kind of astonishing when you think about it. And in the context that Sam Altman, the CEO, has said, like, look, an IPO doesn't work for us. We're a 503(c). The business model wouldn't work if we were a public company. So you kind of question, like, well, why would you buy in then? But there is a lot of appetite.
Ed Ludlow there out in San Francisco here as we continue our coverage on the close. Coming up here, finally an alternative for investors. At least that's according to Bloomberg opinion columnist John Authers, who says bonds and cash finally forcing investors to leave Tina behind. That conversation coming up after the break. This is Bloomberg. A volatile day on Wall Street today. We talk about a market that was really battered around all day long. It started earlier in this session, of course, when we talk about what happened in the yield space. And of course, that trickled in to some commentary out of Jay Powell with regards to higher for longer. And of course, that also was folded into a big day for earnings that disappointed across the board. You saw that reflected in the big downdraft in the major indices. You saw that reflected in the continuous sell-off that we saw in treasuries and a lot of volatility going on in the commodity space as well. Scarlet?
All right. There is no alternative. And of course, when we look at TINA, that's the phrase, the catchphrase, the battle cry that investment analysts and advisors have been saying for the better part of a decade. But sentiment has shifted since the Fed began its retreat from its ultra-loose monetary policy. That's the latest from Bloomberg opinion columnist John Authers. He argues that cash and bonds are looking like attractive parts of an investor's portfolio, and John is here with us now. Hi. John, we see fixed income becoming much more volatile than stocks. Yes. A couple of times, Romaine, you've called it what, the meme stock? Yeah. Almost like a small cap stock in many ways. Yes. This has happened before where we had rates higher. Was this the case in 2006, 2007 when yields were last at these levels, that fixed income was this nutty?
Yes. In a straight way. So you always have to be very careful admitting that there's something similar between today and the early months of the great financial crisis. Mm-hmm. But yes, we had a final sort of blow-off top that took the 10-year yield above 5%. You'll find a piece that I and my now Bloomberg colleague Michael McKenzie wrote about this for the Financial Times back at the time, about whether this meant that the era of low rates had been ushered away. Mm-hmm. The one-word answer to the question we posed in the headline that time was no. And basically what it did turn out was that yields had caused something to break, which, as we know, is the mortgage market. Yeah. And it was the rise in bond yields that time was the catalyst for something very dramatic.
So now that cash, and we can look at the 6-month Treasury as a proxy for cash, yields more than U.S. stocks through earnings yield. Yeah. How are people interpreting that? Is that a bullish sign or a bearish sign?
I mean, if you go with the standard B of A Merrill Lynch view, who ask fund managers every month, the amount of cash people are holding is taken as a contrarian indicator. Mm-hmm. The fact that people are now loading up on cash could therefore be taken as a contrarian bullish indicator. You could certainly argue that it's unlikely, this ties in with what we've heard from Jay Powell earlier today, it's unlikely that rates are going an awful lot higher, so the rates you would be getting on cash would decline from here. So that's peaked. Yes. That said, one of the best predictors of the return you're going to get on a bond is its yield. The higher the yield at which you buy, the better it's likely to work out for you. So bonds plainly ought to be providing very great competition at this point.
It's funny, the way you're speaking about it, you almost sounds like this is some sort of unicorn, but wasn't this the way things were supposed to be?
At what point? I mean, it's not so much a unicorn as some kind of a sort of minotaur or a chimera monster that people have been scared of for the last 15 years. Like, maybe we'll have to go back to a real interest rate that actually rations money.
Yeah. And, how about that?
That's what.
Because everyone keeps saying, I mean this in all seriousness, I'm not even trying to be glib, because everyone keeps saying, oh, money's more expensive, money's more this. I mean, 5%, John, come on.
No, it's not that much at all. Yeah. And you and I can both remember when it was much higher. But the problem is that people have very short memories. Yeah. And generations pass. Like you need to be pretty much, it's very hard to have really had any experience as a trader of what happened in 07 and 08 and still be the right side of 40.
Yeah, absolutely.
And whenever I go through a trading room these days, I feel ancient. There is nobody anywhere near as old as I am trading this stuff. That's on. So that is important.
Okay, just put on sneakers, turn your hat to the back, and you'll fit right in. We'd be remiss in bringing you on. I mean, I know we're talking about 60-40, but we'd be remiss in just not pointing out that today, October 19th, is an ominous day, Black Monday, of course, back in '87 here. And I am curious about not only what led up to that, but whether there are any parallels now, meaning sort of because black money snuck up on a lot of people.
Yes.
We talk about the drop in the dollar. We talk about the same thing. Higher cost of capital, the dry up, the ding that we saw in M&A activity and deal making, all of that was a big contributor to what eventually culminated on October 19th. And it does seem that there are some elements of that we're seeing today.
I certainly agree. I should start with the caveat that although I wasn't yet covering the markets in 1987. That was the last big market event I wasn't around for. That said, I've spoken to so many people about it over the years that it feels like I was there. The critical things that you have in common are, yes, that rates were rising and that stocks had lost their momentum after a very big rise, a much bigger one in 87 than we've had this year. So I published a few weeks ago. It's I think we called it horror chart porn when we did so because it looks so scary. If you do overlay charts,
is it safe for me to search for that on the Bloomberg terminal?
On the Bloomberg terminal, yes. Don't try that on the internet, or at least not on your Bloomberg computer.
I gave up on the internet.
Yes. But anyway, if what you did find was that the way the stock market has behaved so far this year is very alarmingly similar to what happened in 87, and similarly, the other big crash I was around for was after Lehman. The markets had been going down for a while, steadily losing confidence. It didn't crash until a month after Lehman. You generally, crashes don't generally come out of a clear sky. You've begun to realize, oh heck, I'm not guaranteed to make any more money, and maybe if I don't sell soon, I'm not going to keep ultimately.
Well, the good thing is,
and then you get a crash.
Well, the good thing, John, is we've gotten through October 19th, 2023, without a major crash.
We still have the anniversary of the great crash from 1929.
I was trying to end on a high note.
October.
John authors a Bloomberg Opinion. We'll be back in a moment on The Close. Markets on this Thursday performing, well, not a whole lot different than the way they've been performing over the past few days and weeks. A down day for stocks and the sell-off in the bond market resuming, though not as severe as some of the previous days. Most of the action was in the 10-year yield. We saw that early in the session where it did flirt with breaking above that 5% mark for the first time since 2007. It did peel back just a little bit, but that really wasn't enough to arrest the declines that we saw in the equity market, whether that was driven by the macro or maybe it was driven by some of the earnings that disappointed. You saw a 1% drop in the Philadelphia Semiconductor Index, the NASDAQ, as well as the Dow, the Russell, and the S&P 500 to boot, an elevation in the VIX. Of course, we go back to that macro story, and it does become a question here as to when the Fed is actually done. Scarlet, we did hear a little bit earlier from Jay Powell, and he reiterated the message that he's really been trying to get across to this market for quite some time, the higher for longer.
Yep, higher for longer was definitely the theme for his comments today. Fed Chair Jay Powell suggesting the central bank is willing to hold rates steady at its next meeting. He also left the door open for future rate hikes as, of course, inflation remains the Fed's key focus. Here is some of his conversation with our David Weston at the New York Economic Club earlier today.
We all write down our estimates of the longer run neutral rate every quarter in the summary of economic projections. And that's based on models. It's based on also looking out the window and including lags, thinking how are our current rates affecting the economy. So the evidence of your eyes is that the economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough. You're right, though, but we have models for everything. We have formulas for everything. Ultimately, as a practitioner, we have to, be focused on what the economy is telling us, even taking lags into account. What's it telling us? Does it feel like policy is too tight right now? I would have to say no. I think the evidence is not that policy is too tight right now. And we're at 5.25% to 5.5%.
Do you think we're entering into a new phase in monetary policy? We had the Volcker disinflation, I think you referred to it as, and then we had sort of inflation targeting for a time. There was concern about secular stagnation. We were pushing the zero bound, as you said. We were concerned about that. And then we had the pandemic, and we had the real problem with inflation. What's the next phase look like? How would you describe it?
What we've been through is, in all of the advanced economies around the world, was a period where the effective lower bound, the proximity of interest rates, risk-free interest rates to the effective lower bound, which is zero or a little bit less, was a big problem for monetary policy. And just rates came down and down and down. And the problem is, if rates are going to be close to zero in good times, then how do you cut? And so have central banks lost the power of their most important tool, which is interest rates? This was a subject of a vast literature in monetary policy research for 20 years. And you know, the most common answer was some kind of a makeup strategy. So you would credibly promise to run inflation a little bit hot and above 2%, and that would anchor inflation at 2% to counter the times when it was below. So that was a very serious problem, which filled books worth of research. Then comes the pandemic, then comes the response to the pandemic, and then comes the pandemic inflation, not just in the United States, but everywhere. The question is that a secular change, or are these factors that brought us to that place, are they still out there waiting to come back? And you know, books are written on this subject now. You can argue that, and some have argued that effectively the last 20 years before the pandemic were kind of a perfect storm of disinflation. And now that's all gone, and we're going into a more inflationary period that will be characterized by more supply shocks and things like that, and therefore more inflationary pressure. Yeah. So are we going into such a, I don't know. I mean, all I can tell you, I think it's unknowable, and you know, great theorists and researchers have different views on this. It's not something you can settle in advance. We'll have to see. I think our issue is right now trying to achieve a sufficiently restrictive stance of policy to bring inflation down to 2% over time. That's what we're really focused on.
Jay Powell, of course, the chairman of the Federal Reserve, speaking a little bit earlier at the Economic Club of New York. Of course, the man asking those questions was David Westin, the host of Wall Street Week, and he joins us right now here at Studio 2 at our world headquarters. And David, how many times did he say, I don't know, or it's unknowable?
He's a very modest man that way, and I guess that's reassuring. At the same time, really listening to it in a variety of ways. One theme I thought, and I don't want to be reductionist, is if it ain't broke, don't fix it. I mean, the economy's doing really well. It's resilient. Inflation's coming down, maybe a little slower than we thought it might come down. And right now, there's nothing broken. So, you know, the economy's doing okay. So maybe they haven't made a mistake, and they want to be careful.
You asked him a bit about kind of this sort of wait-and-see approach that the Fed has taken, or at least that they've communicated. What did he have to say about that?
Well, one of the things I was curious about is as the yields go up, because that's one of the things we've certainly seen, and it's really caused a lot of concern through the marketplace, and I think through business as well, is are you talking to people out there in the real world, in the business world, who are saying, wait a second, cost of capital is really going up, it's affecting me? He said he's talked this week to several people that said, no, we think the economy's doing fine, we're not concerned about it. I was a little surprised at that. I thought the businesses would start to get really concerned. You go from zero cost of capital to where we are now, that really puts some discipline into any corporate decision making.
Yeah, maybe a lot of companies have already locked in their lower borrowing costs, and so they're just kind of watching how things unfold. One thing, of course, that everyone in the markets is thinking is, okay, the bond market has done some of the Fed's tightening for it through tighter financial conditions. How did he respond when you put that to him?
I asked him that question, as you know, Scarlet, and he basically allowed us, yes, sort of, yes. I mean, it's not quite clear how much it has, but I said, on the margin, does it reduce some of the pressure to raise more, given what's going on? Because it is a tightening financial conditions. And he said, yes, that's the way it works. And if the conditions are tightening the way they appear to be, if they last, then there may not be as much pressure to raise rates.
And of course, you asked a final question, which I thought was so clever, about whether he's enjoying himself. I don't know if you could see his expression, but his eyes shifted a little bit, and there's a momentary panic, maybe, or maybe I'm reading into it. Were you surprised by his answer?
No, I wasn't, actually. I have a sense of it, and other people know him better than I, but I have a sense of him that he takes his job very seriously. He feels the responsibility of it. He's doing it, I believe, for the right reasons. He thinks it's important to do it well, but he also enjoys it. I mean, I think he's a happy warrior. Let me put it that way. As we're about to have the Al Smith dinner, he's a happy warrior.
All right, a great interview a little bit earlier today. David Westin, a sit-down with Jerome Powell, the Fed chairman. And you can hear more of that interview tomorrow on Wall Street Week, which airs at 6 p.m. New York time, right here on Bloomberg Television. Of course, David Westin was on the stage, but pleased to say we have someone who was also in the audience. Bill Dudley joining us right now. He was the Federal Reserve Bank of New York president from 2009 to 2018, or somewhere in there here. And you had a front row seat to this, and I'm sure there's nothing that Powell said that probably wasn't already in your economic brain, but what did you make of his general comments about the idea of the bond market doing a little bit of the Fed's work for it?
Well, he was asked about that by David, and he basically said that he thought the rise in bond yields was mostly about bigger term premium, as opposed to the Fed market expecting a higher path of short-term rates. He basically said if the bond market yields were higher because people were expecting higher short-term rates, then that would put a burden on the Fed to sort of ratify that. But the fact that it's term premium means that financial conditions are tightening without the Fed having to do anything. And so he sort of confirmed the Lori Logan speech earlier this month, where Lori Logan, president of the Dallas Fed, basically said, the bond market's sort of doing some of the job for the Fed.
Does that put them in a more enviable position, or does that actually complicate their job when they go into the next couple of meetings here?
Well, the problem is you don't know where the bond market's going to go.
Well, that's what I'm saying.
And so the term premium could go up now, or it could go up higher, or it could shrink, or the bond yields could move around. So I don't think, I think right now they're a little bit more comfortable because they see this tightening of financial conditions. The speech was actually a pretty optimistic speech about how the economy is performing, because he basically talked about how the labor market was normalizing, wages were coming down, inflation was coming down. The Fed. Basically, you got the impression that he's pretty comfortable with the level of rates, and the fact that the economy is a little stronger than expected. Well, that's a nice problem to have, and the fact that bond yields are a little higher. Well, that's actually maybe going to help deal with the fact that growth is a little bit stronger than expected. He also implied that he expected growth to slow in the fourth quarter going into next year. So I think the Fed's on hold until they see whether the economy slows as much as they anticipate or not.
Right. They want to see those rate hikes take effect and really filter through the economy. You mentioned term premium. That's certainly one reason perhaps driving bond yields higher. You also wrote a recent column in which you cite quantitative tightening as a reason for why bond yields are higher. How big a factor is QT relative to the other drivers? Higher for longer, increased supply of treasuries, concern over the marginal buyer?
It's hard to know because we've only run this QT experiment one other time. So we don't have a lot of experience with how powerful QT is in terms of pushing up bond yields. But the whole theory of QE and QT is to influence the long end of the yield curve and to manipulate long-term rates. So we certainly know directionally that QT is going to tend to put upward pressure on bond yields. And really the point of my piece was that this is going to probably continue for quite some time. By my estimates, the Fed's going to do QT for probably another 2 years or so before they get the balance sheet down to the level consistent with banks' underlying demand for reserves. A lot of people in the market are saying, well, when will the Fed stop QT? Not anytime soon. QT is on autopilot. Once they flick the switch, it runs until they get the balance sheet back down to the desired level.
In terms of repercussions of the end of QT, you talk about upward pressure on long-term rates and the term premium. But what do you think might be some of the unintended consequences of the end of QT that perhaps people aren't talking enough about?
Well, one consequence of quantitative tightening is it basically drains liquidity from the system. And this is one reason why bank deposits are going down now, and people who like to focus on the monetary aggregates are getting very concerned because the monetary aggregates are shrinking. Well, they're shrinking because of quantitative tightening. There's nothing to be worried about this because there's still plenty of reserves in the system. The banks aren't short of liquidity, but you'll see bank deposits start to fall. And one of the consequences of that is banks will probably start to be forced to bid a little bit more aggressively for deposits.
Higher deposit rates.
They'll have to start bidding for deposits. Right now, they have more deposits. A lot of the money center banks have more deposits than they know what to do with, and that's why they're not really aggressively bidding for deposits right now.
One thing that he did say that I guess to me alarmed me, but I want to get your take on it, was he brought up the Phillips curve. And sort of unprompted, he was asked a very specific question about unemployment and that inverse relationship that you have between inflation, or at least you're supposed to have, between inflation and unemployment. And he seemed to kind of defend the use, or at least the reading, of the Phillips curve. Did you have that same takeaway?
Well, I think the Fed still does believe that if you drive the labor market too tight, you will have an inflation consequence. You almost have to believe that, because if you don't believe that, then you don't really have a model of inflation. Basically, people think that inflation is a consequence of tightness on resources plus inflation expectations. If you get rid of that first piece and just say inflation depends on inflation expectations, well, then the question is, what does inflation expectations depend on? So you really sort of don't have a coherent model of the inflation process. So I think, economists believe that the tightness of resource utilization matters. The question is how much and how fast does it show through in terms of inflation. One of the things that benefited the Fed tremendously over the last couple of years is inflation expectations stayed very well anchored. And I think the well anchoring of inflation expectations means that the Phillips curve is flatter than it would otherwise have been.
You're not on the Fed anymore, you're not on the Monetary Committee, but how would you think through the implications of the conflict in the Middle East and what that means for inflation and how you conduct monetary policy?
You know, I think it's really still way too early days to make judgments about that. One thing that Powell said in his remarks is, the Fed takes the world as it is.
Yeah.
So as things evolve in the Middle East, if the news is better or the news is worse, if oil prices are higher, oil prices are lower, the Fed will just take that on board in terms of their assessment of growth and inflation. So I think at this stage, the Fed knows that it's a big risk factor. It creates a lot more uncertainty going forward, but I don't think it's factoring into their near-term monetary policy decisions. We have a whole bunch of other uncertainties too, and we have the UAW strike. We have the end of the student loan holiday. So all these things are creating a lot of questions about how's the economy.
Washington.
Yeah, Washington shut down potentially. And so we really have a lot of questions about how the economy is going to perform in the fourth quarter. He did imply that he did expect the economy to slow. He did acknowledge that third quarter is very strong, but he did basically point to a slowdown in the fourth quarter and into next year. Now, if that doesn't happen, then probably the Fed's got more to do.
All right, great conversation. Bill Dudley there, former New York Fed president and a Bloomberg opinion columnist for us. A nice wrap up here of what we heard from Jay Powell a little bit earlier in the day. Coming up here after the break, we are going to refocus on the situation in the Middle East. Courtney Gelman, Managing Director of Policy Research over at Strategas, is going to be joining us. This is Bloomberg. Turning back now to the situation in the Middle East, just a few minutes ago, we had some breaking news across the Bloomberg terminal. We're learning that Moody's has placed Israel's debt rating under review for a potential downgrade. Obviously, this is tied directly to the war that is still unfolding there. Previously, the outlook was stable. That situation, though, in the Middle East is far from resolved. President Biden made a trip to Israel yesterday. He's scheduled to address the nation later tonight, and everyone is still awaiting to see when that ground assault that Israel has been hinting at into Gaza actually begins. Courtney Gelman joining us right now, Managing Director of Policy Research over at Strategas Securities. And Courtney, let's start off here with military aid. We're expected to get an announcement or at least a speech from Biden from the Oval Office, something that he has rarely done here, presumably to lay out not only our support and our moral support, but more importantly, the idea of how much money and weaponry that we're going to be able to provide. How much of help do you think they're going to get?
The administration we're anticipating is going to be requesting $10 billion in aid, military aid subject or probably concentrated on things like precision missiles and artillery. We've already sent a number of armored vehicles. Probably those will be included in that request as well. That's going to be the Israeli component, but also within that speech, there's certainly going to be requests for Ukraine aid, potentially a full year's worth of funding at $60 billion, as well as additionally some aid to Taiwan as well.
That's a lot of money we're talking about, and we're talking about a Congress that had already, at least certain members of Congress, that had started to bristle at the amount of money we were spending for Ukraine's efforts to defend itself against Russia here. Do you anticipate that we could run into issues in Congress and whether lawmakers are going to sign off on the amount of money Joe Biden will ask for?
So I think we're already starting to see that play out in terms of the House's inability to find a speaker at this point. So it looked like as of this morning, we were on track to give McHenry temporary speaker powers. It seems like that is now running into obstacles. And I think part of that is because there's concern that if you need Democratic votes, which they would to be able to elect McHenry to the temporary speaker position, then you'd be doing a larger amount of aid, potentially close to that full $100 billion that the administration is asking for, and that would be unfunded as well. So I think that we're already seeing that play out within the House right now.
We can talk about McHenry in just a bit, but I wonder if the White House, President Biden, has any ability to take executive action when it comes to aid to Israel.
We can certainly do things in small amounts and certainly send certain equipment. We do store missiles in Israel. He's already given them some access to those, and he can send some other smaller amounts of aid. but to be able to do a larger package like the scale that Israel is saying that they are going to need, especially if this is a long duration conflict, we do need to have Congress and a Speaker of the House in order to pass that.
Okay, so let's get to the Speaker of the House, of which there is none right now. There is a temporary Speaker, Patrick McHenry, and a lot of discussion between Democrats and some Republicans that perhaps they can make his role a little bit larger. But there's pushback about whether that's even possible. There are no rules when it comes to this because this is a fairly new role. What is at issue here, Courtney?
So right now, with the temporary powers that McHenry has, since he wasn't elected, he was appointed to that, he really can't do anything. His sole job is to find a new speaker. If he does try to take any actions, that's subject to lawsuits. So they certainly don't want to go that path.
Lawsuits from who, Courtney?
Lawsuits from anyone that would be affected from that legislation. A member could bring up a lawsuit if they wanted to. So that's why they don't want to go that route. They don't want to have any challenges. And also, we're not being attacked directly at this point. So in terms of using emergency authorities, it just doesn't seem like there's that urgency. They want to, at this point, try to either elect McHenry to the temporary speaker position, or Republicans want to elect a speaker outright. We could potentially be seeing another vote on Jordan this afternoon in an attempt to see if they can make any progress.
And just real quickly here, Courtney, on that level, I mean, even if we get sort of a temporary leadership sort of agreement here, there's been a lot of discussion that once you get the new Congress in January, we're basically going to have to go over this again. Is that correct? That just procedurally, we would actually have to go through another vote?
So if they do a temporary vote on McHenry, they could do that for any duration of time. They could put a limit on it. They've been saying that they would want to do it until January, but they could do it, indefinitely as well. There's no rule in terms of how long you could have a temporary speaker.
All right, Courtney Gelman, Managing Director of Policy Research over at Strategas Securities here. A look at the geopolitical issues out there. And once again, Joe Biden set to address the nation from the Oval Office. This will be only his second address from the Oval Office as president, of course, one of the most prestigious platforms to speak to the American people. We're going to set you up for what investors are going to have their eye on Friday, so stick with us. This is Bloomberg. All right, as we wrap up our coverage here on this Thursday, we want to set you up for what investors are going to have their eye on over the next 24 hours or so. And we're actually going to start tonight, 8 p.m. Washington time. We're going to hear from the President of the United States.
8 a.m. in Asia. So, of course, the Asian trading day has begun. The President, of course, going to speak about the conflict in the Middle East, how the U.S. is going to respond following the return of his trip to the Middle East. Yeah, a rare Oval Office address from the President of the United States. And then over in Europe tomorrow, European Commission President Ursula von der Leyen and European Council President will be meeting with President Biden in D.C. Yeah, perhaps looking for some kind of more robust response to what's happening there. Yeah, and I'm told this is actually going to be their first meeting in 2 years. So interesting meeting there. It'll be interesting to see whether they're on the same page. And guess what, Scarlet? More Fed speak tomorrow. I know you're excited. It feels like the climax was, say, when Jay Powell spoke. Yes, we're going to get Mester and Harker to speak, but what are they going to say that's different at this point? Yeah, and we should point out, of course, that quiet period coming up this Saturday ahead of the next meeting and more earnings before the bell tomorrow. You get a couple. Yeah, American Express is going to be reporting. There's also some regional lenders as well, Comerica, Huntington, and Schlumberger. So we get oil services companies in the mix, too. Yeah, a little bit of a cross-section of our economy here. Thanks for joining us. Stick around. Balance of Power, they're coming up next. They're going to have full coverage and all the House speakership drama. And of course, Scarlet and I and Katie will be back tomorrow. Thanks for watching us. This is Bloomberg.